It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith, and this is the Yahoo Finance Live. Here are three things you need to know this morning. The UAW strike against the big three automakers enters its fourth day. Talks continued over the weekend, but a deal is still elusive. On Friday, 9% of its nearly 150,000 members downed tools as a strategic strike began. The union's president, Shawn Fain, rejected Stellantis' offer of a 21% pay bump over the weekend. Now, the union head told CBS's Face the Nation, quote, "If we don't get better offers, then we're going to have to amp this thing up even more."
And it's that time again. House Republicans have released a bill intended to avoid a government shutdown on October 1st. The deal being tabled is very much viewed as an opening gambit and includes an 8% temporary spending cut for domestic agencies. It will likely be rejected by the Democratic-led Senate, and the bill includes border provisions which likely make the plan dead on arrival. A vote on the bill is planned for this week.
And don't ignore the Fed. The September meeting has largely been brushed off as a surefire hold, but the expectations around the ECB were similar, and that central bank surprised investors last week. Fed speakers have had something of a more cautious tone recently, but with oil still causing a headache, any commentary around higher prices is going to be closely watched. The Bank of England, meanwhile, preparing for what could be the last hike of its cycle.
Well, we've got a big week ahead, and here is what we're watching. Over the weekend, House Republicans unveiled a deal that would push the shutdown deadline to October 31st. But the bill's provisions aren't popular among Democrats in the Senate, meaning it's unlikely to pass the chamber here.
And oil creeping higher yet again this morning, fueled by supply cut extensions from Saudi Arabia and Russia. High gas prices were to blame for an inflation speed up in August, a red flag for the Fed.
And a big week for housing data, starting later today with the Home Builder Confidence Index. What will the latest numbers show us about record low house affordability? All right, so let's pick this apart just a little bit here, Shauna, because if we think about, of course, what is going to be an investor's kind of eyesight and mind, first and foremost, it's going to be what the Fed says, even though this is looked at as somewhat of a nothing burger type of meeting and all eyes being on November. So in this interim period of time, you've got more economic data, and especially on the housing side where we've heard more from the Fed just about how they're continuing to track affordability and whether or not homeowners are willing to list some of their existing homes, because many of them don't want to get into a higher rate themselves if they then have to purchase a new home once they get out of that one, and struggling to find buyers given the financing options available.
Yeah, Brad, there certainly is a lot on the plate right now. The Fed has an extremely tough job, especially at this point in the economic cycle. They're trying to figure out exactly what is needed to bring inflation back to that 2% target. The Fed has not backed down from that 2% target, but like you said, higher oil prices, higher gas prices could be a bit of a headache here for the central bank, especially when we talk about that last mile, what exactly needs to happen in order to see a continued improvement on inflation. But when it comes to oil prices, right now we're sitting at the highest level that we've seen in just about 10 months. Wow. I want to point out, though, there was a note out here from Citi this morning and Morse over there saying that prices, they could top $100 a barrel, but they likely will not stay there. He talks about, even though we are seeing supply cuts from OPEC members, supply from countries outside of OPEC, like the U.S., likely to see supply ramp up there, increase by about 1.8 million barrels a day this year, by another million barrels a day next year. So maybe that, at least down the line, when we talk about the next couple of months, that could ease some of the pressures that we're seeing on oil prices, and therefore help the Fed in its case here trying to get inflation under control. But I think oil prices is going to be one of those top things to watch this week and then going into the end of the year.
Absolutely. Trickles down and hits everything from just our transportation, how we travel day in, day out, also the goods that are produced as well. So all of these costs get factored in one way or another. And then you think about the timeline that we're going to be watching for this week. We've also got some Fed speak towards the end of the week. That's going to come on Friday here after the decision is made, the interest rate decision coming on Wednesday here. So all of that considered, you're going to be looking at housing to start off the week. You've got the Fed midweek, and then, of course, to cap off the week with some of that Fed speak that we mentioned. Going to be looking for that from, it seems, Cook, as well as Neil Kashkari, Minneapolis Fed president, as well as Mary Daly, San Francisco Fed president. So all that coming forward this week.
It's certainly something that investors will be closely listening to. Any indication, any commentary there from other Fed officials just in terms of how they're looking at future rate hikes potentially. All right, well, the top story of the day here, the United Auto Workers Union is entering its fourth day of its strike against Detroit Big Three automakers. Now, negotiations between the UAW and General Motors, Ford, and Stellantis are still ongoing, but have yet to see much progress. Now, after failing to reach a new contract agreement, 13,000 UAW members went on strike last week at 3 plants. You can see them there on the screen. The UAW has threatened to increase the number of striking workers as negotiations go on, which many fear could have repercussions across the broader economy. And that includes hits to GDP as well as the labor market. We talk about the fact that these numbers, the fact that the strike likely won't be evidence here or shown here in the jobs report, and unless the strike lasts through mid-October, then we could see that in the next jobs report. But again, just so much uncertainty around exactly what this is going to look like. If the automakers are forced to negotiate and reach an agreement, higher pay levels than maybe what they had initially anticipated, that could be a real challenge here for the Big Three, at least in the short term.
You know, we had some interesting conversations over the course of last week, and especially this being such an historic point, especially in negotiations between the automakers, for many of them who had expected us to not get to this point. If you were listening in on earnings calls for GM, they were acknowledging the likelihood or the perhaps moment of a strike that could come forward, but many of them believing that negotiations were much more kind of rosy than anticipated, and now getting to this point. Larger question, not just for the automakers, but also for suppliers that have major contracts. And even as those contracts go further on for years, this could change the way that the automakers negotiate with suppliers in order to make sure that they're able to offset costs one way or another. Now, if you're looking at the shares or ticker pre-market of Ford, GM, you'd be right to do so, especially given the fact that we've got Ford with some pre-market movements just fractionally lower here. So we'll continue to watch that. It's down by about 0.7%. But over the past 5 days, still holding on to some net gains here. And so we'll see exactly as this continues to have more life to, or time span at least, to the strike, what that means for the stock price reaction and whether or not investors are fully pricing this in yet.
Yeah, certainly a huge headwind here. And then when we talk about some of the broader economic implications, so the initial estimates that we were getting out there, one of those was from Anderson Economic Group, and they said that a 10-day strike could lead to more than $5 billion in losses. Now, we have at least seen the first 4 days, because today's day 4 of the strike, it's just at select plants, right? So that economic impact likely will not be as great as maybe some of those initial forecasts. But Moody's is out saying that they estimate it to be having about a $45 million impact a day on the economy. So it does in part raise a bit of a risk here when we're talking about recession, a possible recession, what exactly that could look like. Obviously, that risk rises here the longer that we see the strike go on. And of course, whether or not we see the strike broaden out just a little bit, like Fain was threatening over the weekend.
Absolutely. Much more discussion on that coming forward later on in the show. But in the meantime here, stocks, they are on the move this morning as we're tracking futures. As of right now, they are down across the board for the Dow, the S&P 500, and the Nasdaq. And investors are looking ahead to Wednesday's Federal Reserve meeting. The consensus among analysts over the Fed's next move has gone back and forth, with the CME Fed Watch tool now showing that almost 70% are anticipating that rates will hold steady through the November meeting. Goldman Sachs echoed this sentiment in a recent note, with the strategist saying that the labor market rebalancing and better news on inflation, the FOMC can likely forego a final rate hike this year. Joining us now is Christina Hooper, Invesco Chief Global Market Strategist. Christina, great to speak with you as always and get you some of your insight around this. This is, I put it earlier, as a nothing burger type of meeting. I don't know, from your perspective, is that accurate, especially given the fact that much of the kind of estimate or the probability from the CME Fed Watch tool, at least, is expecting that we're not going to see any type of movement in a hike or a cut at this coming meeting?
Well, I would argue that it's not entirely a nothing burger, because any Fed meeting, as we get close to or are really at the end of the Fed's rate hike cycle, is important. Now, having said that, do I think the Fed is going to hike rates this week? No, I don't. And I hearken back to a meeting last year in June of 2022, in which the Fed had communicated in advance of the meeting that it anticipated hiking rates 50 basis points. But then it got two data points just a few days before the meeting that caused it to actually hike 75 basis points. And that was CPI and Michigan inflation expectations. Well, we got both of those prints last week. And I think the Fed will be comfortable with where we are and will be comfortable sitting on its hands. That was the one potential spoiler, was getting one of those data points that suggested inflation's a bigger concern. But that didn't happen. And so I think the Fed is not going to do anything at this meeting.
Christina, how do you think the markets, or how should the markets be looking at the recent jump that we've seen in the price of oil, how that's going to factor in to the inflation equation, and the Fed really potentially having to get more aggressive here down the line in order to see a material slowing in inflation?
Well, the Fed is really focused on core CPI, and it takes time for higher oil prices to filter into core CPI. So if this is a relatively short-term problem, and I suspect it is, just because, as you mentioned, we're likely to see more production, more supply come online with time, then it's unlikely to be a very big concern for the Fed. Now, it can certainly alter consumer inflation expectations. It can seep into core inflation. So I don't mean to dismiss it, but I don't think it's going to alter the Fed's path in the near term.
We've already heard some calls for a rate cut, some of them as early as first quarter next year. Do you believe that the Fed, even as they're getting towards the end of their tightening, are signaling or at least having more advanced discussion around what a cut could potentially do to spur at least some people back into the housing market, as we continue to track and are expecting even more data on that front this week?
Well, I'm sure there are probably at least a few members of the FOMC that are eager to get to that discussion. I don't know how premature it would be at this point. But having said that, we have to recognize there are lagged effects for monetary policy. So I suspect that we are going to see a deterioration in economic data. I don't think we're going to have a hard landing, but I do think we're going to have a bumpy landing. And that could push the Fed to really seriously consider in coming months when it is going to cut. And it could start cutting as early as the first quarter of 2024. I know it's not inclined to. It would rather keep rates higher for longer. But as you rightly pointed out, housing is a big concern. We've heard as much from different members of the FOMC that they were somewhat surprised by what's happening in housing because of the rate hikes we've seen. And so there are certainly reasons for the Fed to start cutting, but they're not compelling yet. But hopefully those discussions will begin soon.
Christina, when you talk about some of the uncertainty, some of the risk out there, housing, higher oil prices, and then we also have the UAW strike. How big of a macro risk is that to the markets in the near term?
Well, it all depends on the length of time for this strike, as well as how broad it is. Right now, the UAW is being strategic and essentially targeted plant closures, as you mentioned. So it's not going to have as dramatic an impact as it would, given that they're striking at all three U.S. big automakers. So it certainly, if it grows in size and grows in length, is going to be more impactful. But hopefully they will come to an agreement sooner rather than later. And that way, the impact on the economy, on GDP, will be relatively de minimis.
Is there any specific portfolio repositioning that investors could or should be considering going into this week's Fed meeting?
I don't think so. I think investors should recognize that typically once the Fed stops hiking rates, we tend to see the stock market perform well in the 1 year and 2 year periods afterwards. However, I don't think we're going to get clarity at this meeting that the Fed has stopped hiking rates. Even though it could very well be the end of the tightening cycle, we're not going to get clarity on that just yet. So investors need to be patient. They also should recognize that we're likely to see heightened volatility in the near term, because volatility is very often the product of policy uncertainty. So we don't just have Fed policy uncertainty, but we also have uncertainty around the government shutdown. Now, that shouldn't change anyone's allocation who has a long time horizon, but it should be an important consideration so that investors don't get spooked by what could happen in coming weeks.
All right, Christina Hooper, always great to get your perspective and insight there. Invesco Chief Global Market Strategist. Thanks. Another big story that we're watching, FedEx earnings. The logistics giant is reporting results for its first quarter on Wednesday. Now, according to Bloomberg, Street consensus is for revenue of $21.85 billion. Unadjusted earnings of $3.75 a share. Now, many analysts, including our next guest, remain optimistic ahead of the earnings release. You can see 19 analysts have buy ratings on the stock, 15 hold, and just 1 sell. We want to bring in Chris Wetherbee, Citi Research Global Head of the Transportation Sector. Chris, it's great to see you here. So lots of anticipation going into this report here that we're going to get from FedEx later this week. What do you expect we'll hear from the company?
Well, we think the company is actually going to report a relatively decent fiscal first quarter. Now, you have to remember where FedEx is coming from. It had a very challenged fiscal 23, really starting about a year ago in the fall of last year, when global trade deceleration really hurt their biggest business, which is their express segment. We think a lot of that is behind us at this point. We're beginning to see some relative improvement off of what's a very low level. So in terms of earnings for the quarter, we're looking for about $4 a share. So we're a bit above consensus. And we think ultimately we're going to see okay results from express, but probably pretty good results from ground and then their freight segment, which is LTL trucking.
Is there any significance in UPS just kind of getting through and announcing their newly ratified contract just last week, making sure that they've also got, you know, their logistics house in order, if you will, at the same time that FedEx, of course, different classification for their worker types, but at the same time, they had been going out, it sounds like, to customers and saying, hey, look at the issues that UPS is having. Now with those kind of in the rearview mirror, does that change the equation for taking on even more large contracts?
I do think one of the things that we'll see in FedEx's fiscal first quarter is a degree of market share that moved from UPS to FedEx. So remember, FedEx's quarter was through the end of August, and UPS was going through those contract negotiations really over the course of June and July in a very sort of hot and heavy way. And so we do think there's a relatively large amount of shippers who move some degree of volume over to FedEx. So UPS has talked about 1 million packages per day of diversion, and about a third of that going to FedEx. That'll show up in FedEx's ground business. Now, that's part of the reason why we'd expect the ground segment to report a relatively strong result. Now, that's not something that necessarily can last to the same degree, the same amount of strength throughout the year. We do think that some of those customers will transition back to UPS, but in the short run, it definitely is a tailwind for FedEx as they were open for business. And I think there was some concern from customers that you could see a work stoppage at UPS, and so some risk taking off the table by moving over to FedEx.
Chris, do you see that for the bankruptcy of Yellow that we saw in August, just in terms of the fact that they could potentially win a little bit more of market share there, at least over the coming months?
Yeah, that's absolutely right. So Yellow going out of business during FedEx's fiscal first quarter as well is going to be another tailwind. Now, that has the potential to stick around for the rest of the fiscal year and really ongoing because the doors are closed at Yellow. So FedEx, being the largest LTL company in the country, should benefit decently from not only just shipments moving over from Yellow to FedEx, but also pricing, which was strong to begin with in the LTL business, but actually is probably getting stronger as a result of reduced capacity. Remember, Yellow is about 6.5% of overall shipments in the market, and a little bit bigger number than that in terms of revenue. And so that capacity coming out should really tighten up the LTL market, benefiting pricing. And obviously, they're getting their fair share of volume moving over too.
Chris, you got a new CFO at FedEx now. What should investors, what should viewers who are tracking this ticker every single day, what should they keep an eye on with regard to his own track record? I believe this is John Dietrich, who is going to be taking over at this role. What should they be watching for in that type of financial leadership style, and how that could perhaps flow through to some of the price action as well?
So I think the addition of a new CFO is a good thing ultimately for FedEx. And I think what you're seeing here is you're bringing in an executive who's got a strong background in global air cargo market. And that, again, kind of ties into FedEx's biggest business, which is the express segment. I think that ultimately is an area where they need probably the most help. So ground and freight have been generally steady performers over the course of the last several years, where express has had significant volatility, both up and during the pandemic and then down post-pandemic. And so getting a degree of stability and bringing in an executive who's got a strong track record executing in this global air cargo market, I think goes a long way. Ultimately, sort of better financial discipline to improve the company's results, as well as focus on, CapEx and return on invested capital. Some of the things that investors are really focused on with a company like FedEx, I think is going to be a positive. So we're excited about that.
All right, Chris Weatherby, who is the Citi Research Global Head of the Transportation Sector. Chris, thanks for taking the time here this morning. Certainly appreciate it.
Thank you.
All right, we've got all your markets action ahead live from the Nasdaq market side in Times Square. Stay tuned. You're watching Yahoo Finance. Make sense out of what's happening in China for us, and are we getting any more clarity that we need on the markets front?
So China is stimulating its economy. A lot of people think they're not, but they clearly are doing it. But it takes time, and I think that China is not in a policy that we did, like a big reopening and trying to stimulate it through free checks and say, let's go and spend a lot of money. Chinese consumers are different. They're also very cautious because what happened during extensive lockdowns, they're wary. But there is some change, and I think that this is about China being very gradual in its approach, knowing it can reach its goal for 5.5% growth. It may not happen this year, however, it may be something for next year.
I'm Shauna Smith alongside Brad Smith and Yahoo Finance's Jared Blickreed live at the Nasdaq market site. We've got about 5 minutes to go here until the opening bell. Let's see what some of the movement looks like ahead of the week. Jared.
Yes, a lot of red here, but can we just acknowledge the beautiful view we have? Usually I'm indoors here. I feel like I want to do a weather hit, but we got to talk about all this red on the screen. You can see Apple here. By the way, all the backgrounds here, if they're red, that's what they did. Friday, they were down. Apple actually up about 63 basis points in the morning here. Here's a year to date. I'm looking at some support levels here. I'm going to be very watching these very closely this morning. If Apple breaks 175, 170, watch out, because tech can roll over hard and lead the market down. But let's take a look at the sector action, because it's not all red. We have energy in the green. That's up about 84 basis points in the upper left. Another thing that strikes me about this screen right here is that everything is in the red, at least the background color. That's from Friday. We're coming off a very strong down day, the first one that we've had in several weeks. And I'll get to the importance of that maybe in a little bit. After energy, we have healthcare, industrial, staples, communication services, all of those in the green. And then to the red, in the red, we have consumer discretionary, tech, and materials. Let's take a look at the energy market. We've been talking about crude oil, so I'll just kind of gloss over some of the bigger names here. In terms of the majors, we got Exxon up about 0.8%, Chevron just behind it, Shell up also about 0.8. So looking kind of muted here, although we are seeing that green. And just let's take a look at some of our leaders here, because interestingly, look at that, cannabis down about 3.4% after an incredible run over the last 2 weeks. But for the most part, guess what, guys? Crypto is leading the way here. FIDO up 3%.
All right, let's talk a little bit more about crypto. What are we seeing right now with Bitcoin specifically?
Well, here we have our crypto scene. Here's a lot of green, wow, if you're into that. Bitcoin up almost 3%. This is a year-to-date chart. Let me just put some lines on here so we can see that a little bit better. But I'm going to draw in a support, and that is right at about 26,000. I think what's really interesting, we dipped down and tested just below that point about 2 times, and now we are off to the races for the second time. So kind of history repeating itself. But the big number is about 31,000. Until we clear 31,000, crypto is not in the clear, guys.
All right. Here's a lot of green if you're into that. I'm going to get that on a
We're
t-shirt.
always into that.
Yeah.
Kermit here. Kermit the Frog, right?
Thanks so much, Yahoo Finance's own Jared Blickreed. Stay with us before the bell here. We're also watching Clorox as of right now, as we've just got a few minutes before the opening bell here this morning. Shares are on the move. They are lower by about 1.75% here today. Now, this comes after the company said a cybersecurity attack last month will have a material impact on its earnings. The company saying the attack damaged portions of its IT infrastructure and disrupted operations. Clorox saying it resumed production at the vast majority of manufacturing sites, but did not give a time frame for when operations would be completely back to normal here. Now, this coming in a wave of cyber attacks that we've seen over the past few weeks here, most notably a lot of people who perhaps bet on the sports, if you will. They most notably will think about Caesars and MGM, but Clorox here. And I think what this is more telling of in a broader story is how much more cyber investment from companies and their chief information security officers, and I think for the CFOs to consider exactly how much they need to spend, how that's going to be prioritized over this coming year as well.
Certainly it's becoming more and more important, like you said, because these cyber attacks are becoming more and more prevalent. So companies are forced, whether they want to or not, to spend on beefing up some of their cybersecurity departments here in order to best position themselves to counteract against potential cyber attacks. So when it comes to Clorox clearly having a real impact on their business, they talk about the fact that they were not able to fulfill some of the orders that they needed to, that obviously having a material impact, which is what the company is expecting in its fiscal Q1 results. Now, they also went on to say that the attack damaged their IT infrastructure. So it caused order processing delays, elevated level of product outages. Now, they didn't go on to say what the long-term impact is going to look like, mostly focusing on some of those challenges here in the near term. But Brad, like you said, this is far from, obviously, the only cyber attack that we've been talking about.
Right.
Even over the last couple of days, when you talk about what has played out at MGM, what has played out at Caesars, and how the companies handle it, right? Whether or not they are paying ransom in order to get back their operations, or whether they're holding out like MGM did. And then, of course, the potential ramifications of that when you talk about lost business.
2 tickers I would say for people to keep an eye on, and it's ETFs, HACK and CIBR as well. Anytime you hear about some of these cybersecurity stories, they have the propensity to move some of these cybersecurity tracking indexes and ETFs that are out there. ETF hack is actually up 5% over the past month.
All right, well, let's get to the opening bell on Wall Street and do a quick check of the markets. This is sponsored by Tasty Trade. We're looking at that ringing of the opening bell right now and taking a look at where things are trading as we enter the first couple of minutes of the trading day. It looks like we're still seeing a bit of pressure here across the board with all three of the major averages. It looks like right around the flat line or trading to the downside when it comes to the S&P and the Nasdaq. Jared Blickery, it's a closer look at these moves, Jared.
Hey there. Well, we were just looking at Apple. Apple actually ended up opening in the green here. Not a big surprise, but I wanted to track NVIDIA. NVIDIA down about 2.7%, as you can see on your screen. This is a year-to-date look. You can see the huge uptrend underplay, but when you take a look at the 3-month, it's at the lower end of its trading range. And by the way, that high was on its earnings day. So not going to really think too much about these moves until we hit, say, testing that 400 area a little bit south of here. Just taking a look at some of the sector action, we are looking at the strength in energy. Energy, indeed, the leader here, XLE up at 87 basis points. That's followed by staples, XLP, then healthcare, utilities, communication services, and industrials. All of those rounding out the top layer there, top row in green. And to the south, we got consumer discretionary, that's down about 0.2%. Tech right there with it, and then also real estate. We had some weird leadership by utilities last week, not really seeing that this week, but I do want to take a look at tech. It was the worst performing sector last week. Here's a look inside at software. You can see a couple of green squares or rectangles, Activision Blizzard, IBM, Atlassian, but for the most part, seeing some downside price action. Then in semiconductors, very similar story. NVIDIA leading the way down about 3%. We got Micron, Global Foundries also in the green. We did take a look at energy before, so I want to take a look at the banking sector. Value kind of split today. We saw an up move in energy, but a down move in banks. And just kind of rounding out things, I want to take a look at what's happening in travel. And not a lot of green on the screen there either. So I did talk about the big down day that we had on Friday, and I want to take a look at this slide here, if we can get to this real quick. There we go. Here is the year-to-date in the S&P 500. All these blue dots are 1% down days. We haven't had two back-to-back just yet. If we have that, I think it might mark a real character change in the market, guys.
All right, Jared, something that we will keep an eye on. Jared, you mentioned some of the movement that we're seeing, some of the chip stocks, Micron, and we want to start there because shares, like you said, they're moving higher this morning. Deutsche Bank upgraded the computer memory and storage company from hold to buy. They also raised their price target on the stock to $85 a share. That's up from $65 a share. And Brad, this all comes down to pricing for their DRAM chips here, improving faster than expected. A lot of that being driven by demand for AI servers and the critical part that their chips play in this, and they think it's going to have a real impact, material impact here in the coming quarters, with that pricing likely accelerating here on out.
Yeah, big dram-tam story here. For Micron, as you take a look at some of the returns that we've seen over the course of this year, largely mirroring what we've seen within the Nasdaq 100 on a percentage basis. One of the other things being called out, particularly within this report as well, and this is coming from the analyst Sidney Ho, basically saying, of course, as you were mentioning, the pricing power with semiconductor direct random access memory, that's the DRAM that we were talking about a moment ago, hitting an inflection point. And one particular quote that jumps out, they had a previous neutral stance on Micron driven by levels of excess inventory in the supply chain, weak macro and demand. They now see the worst of the down cycle behind them. And so that has given some of the aggressive production cuts by all suppliers, as well as pockets of demand strength, particularly in AI servers here. And so that particularly going to be interesting to continue to watch for this story with Micron Technology. We also got to talk about Planet Fitness here this morning. Shares of Planet Fitness have been on the move since late last week, as Planet Fitness shares are still continuing to move lower by about 0.8%. Just last week, the veteran CEO, Chris Rondeau, abruptly announced that he was stepping down. Craig Benson, a 6-year board member, was named interim CEO. And this one, Shauna, really took the street by storm here. And when you think about just the lifetime that Chris Rondeau has really kind of governed and steered this company, the entirety of their existence as a publicly traded company, and even time before that. Now the larger question, and we saw the share price reacting because now there's a question mark. There is that uncertainty about what new leadership will prioritize over top of Planet Fitness. Many of our viewers should remember that this is essentially one big marketing engine for a lot of their franchisees out there, and so particularly interesting to see what that new leadership strategy is like coming forward.
Yeah, it's going to be so critical, and like you said, some of those question marks have been reflected in the analyst reaction that we've gotten over the last couple of days. Jefferies coming out reducing their rating here to hold, saying that there is a potential damage here just in terms of the relationship with the franchisees. The fact that this was such an abrupt departure, many did not see this coming. Raymond James lowered their price target by more than $20 a share to $66 a share. William Blair called the news abrupt, saying it did not appear planned. So when you have an announcement like this, the fact that it is so significant, like you were talking about, the fact that the CEO was there for such a long time, and the fact that he had really steered the direction of this company, a new person at the helm right now is causing some anxiety out there amongst investors. We saw that play out in the initial drop that we saw last week shortly after this was announced. And then again, like we said, shares continuing to remain under pressure here, at least at the open, off just about 1%.
You know, I'll just say one thing here, Sean. Does this mean that we will finally get some new colors at Planet Fitness?
I hope so. I've actually never been into a Planet Fitness.
Really? Look, I'm a Black Card member at Planet Fitness, and yes, I am. I pay $35 a month, and I go there once every 6 months. At the end of the day, I just need some other colors besides purple and gold in those gyms because, my goodness, it is an eyesore at certain points. I'm averse to the color yellow, so it is really tough for me to go into some
So they make those
sections.
changes. What do you think? Could we make it
those
twice
changes,
in 6 months? Three times?
Look, I'll be there 3 times a week if they make the color changes.
Heard it here first.
Yes.
We'll see. That seems pretty simple.
Yes,
Something that they
please.
could do pretty easily. All right. Well, another automaker that we are watching this morning, we talked about the UAW strikes, but right now we want to focus on Tesla because shares of Tesla, they're off just about 2%. Goldman Sachs lowered their profit forecast for the EV maker, saying that recent price cuts are likely going to weigh on overall profits, something that we've talked about now for several months. With Tesla, there was also a report out from the Wall Street Journal saying that Tesla is in early talks with Saudi Arabia to set up a manufacturing facility in the country. Now, that is according, like we just said, to a report here from the Journal. Let's first start with what Goldman has to say, Brad, about Tesla, because they're echoing what many analysts have been warning about now for several months, the fact that Elon Musk and Tesla have lowered the prices numerous times on their vehicles. It's going to pressure margins here, at least in the coming quarters. They're doing, in theory, to boost demand for their cars. Whether or not that turns out to be a good move, we'll see by the numbers.
Yeah, and I think for what we're looking for from Tesla at this point in time, and we got to remember for the broader EV landscape too, that there's so much investment that's being put forward in meeting some of these lofty goals, whether it's Ford or GM, but for Tesla and the head start that they do have right now, it's about making sure that they secure their ecosystem. And so with that in mind, what does this ecosystem look like? It means getting people into a Tesla vehicle, whether it be mass model or perhaps getting them to matriculate, if they're already in a mass model, up to one of the higher end, more profitable, the S or the X, even though the lion's share of orders are the 3 and the Y at this point in time. And so that being really their approach and making sure that you get people into the brand to start off and then layer on some of the other services, some of the other kind of, if you will, member type of features that many of the other automakers, legacy automakers, have gotten people into the vehicle and then just said, okay, cool, we could trade in, we could trade up, and we can make sure that you stay with our brand for a longer period of time. That's the relationship that Tesla is trying to put forward over an extended period and in several different markets as well here right now too. And that's becoming more evident as of some of the reports this morning as well.
Yeah, it's extremely evident here. But again, we're still looking at shares under pressure, at least for now, in early trading, off just about 2%. We'll keep it right here. We've got all your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year, potentially, but going forward, I think that's one thing investors need to be paying attention to.
Welcome back to Yahoo Finance Live, everyone. We're with you from the Nasdaq market site. Let's get you the market commentary of the day. We know the U.S. stock market has been quite resilient in 2023. S&P 500 index up a hefty 15% so far this year, and it seems more strategists are boosting their year-end outlooks to keep up with the rally they never expected. Society General's Manish Kabra raised his year-end target on the index to 4,750 from 4,300. And Oppenheimer Asset Management's John Stolfus lifting his year-end price target on the S&P 500 to 4,900, up from its 4,400 December projection. Despite strategists moving their forecasts higher for the year-end, they aren't quite ready to run with the bulls, and there's still a lot of economic uncertainty here. So even as we kind of reassess or see many of the street projections reassess or rejigger their projections here, I think it comes with a few acknowledgments here. Number one, it's been the year of AI. AI has absolutely been lighter fluid for much of the returns that we've seen over the course of this year. There's a larger question, and we were having this conversation towards the end of last week as to whether or not there's an AI rug pull that we could potentially see before year end, where it becomes, and it is already more of a show me story, especially when you've got everybody from NVIDIA to Coca-Cola talking about how they're going to be using generative AI. Now it's more of investors demanding, okay, where is that going to start to show up in some of the margins and some of the financial performance? And I think that AI rug pull starting to get priced in or factored in a little bit more now with specific numbers.
Yeah, we are starting to see some worry about that. We saw that reflected in the recent earnings results. Some of the companies that weren't able to communicate to their investors, to their shareholders, about how exactly AI is boosting profitability for them, boosting revenue here in a very short time period. Those were some of the companies that had been punished following their results. But something that is a bit encouraging, yes, it was all about AI, all about tech, the rally there in the first half of the year. We have started to see market breadth widen out just a bit. And a number of strategists that we talked to here at Yahoo Finance talk about how that is very encouraging. And don't forget that we had a very successful IPO of ARM last week. We're looking ahead to two more big debuts this week. That could potentially help investor sentiment. So I think more and more strategists are coming around to the fact that, yes, they started the year forecasting a recession, and then ultimately they thought we were going to see a massive pullback in equities. Here we are with just 3 months left in the year, and they're starting to say, hey, maybe it's not going to be that bad. A lot of their baseline case now is for a soft landing. That's also what we're starting to hear, what we have heard from the Fed now for quite some time. So because of that, we're starting to see some of those year-end price targets creep up just a bit, but they're running out of time. They almost have to do it at this point, right?
Yeah. To make sure it's still in the right.
Well, we will see. We got 3 months to go and figure out who, I guess, is going to be right on their calls by the end of the year. All right, well, as the UAW strikes continue, the future is still uncertain. Ford telling 600 workers not to come back to work at a Michigan assembly plant. And GM warned that 2,000 workers are expected to be out of work at a Kansas assembly plant. Now, for more on the effects of the strike, we want to bring in Neil Bradley, U.S. Chamber of Commerce Executive Vice President and Chief Policy Officer. Neil, it's good to see you here. So let's talk about the economic implications of this, because we initially anticipated, or at least we're bracing ourselves for a massive strike. At least for right now, the strike is targeted at 3 plants. So what are the ripple effects? What are the economic implications of the strike up until this point?
Well, Shonda, you're exactly right on the ripple effects, and that's the way I would describe it. You're already beginning to see some of those ripple effects, as that you have other plants where a strike is not occurring, but that rely on parts and inputs from these other plants being affected. That's likely to continue, and it's likely to spread. You've heard from the UAW president that they may accelerate and expand this strike. So even in the short term, we're not out of the woods yet in terms of the negative economic consequences. Though I think left almost undiscussed, and it should be discussed a lot more, is the long-term impact of this on 2 fronts. One, the demands that the union leadership has are only going to increase costs for consumers. If they get anywhere close to what they're demanding, you're talking about making these companies less competitive in the future. That has broader long-term ramifications. And then second, it's really fueling what we've seen as a summer of strikes, where you have these unrealistic, almost excessive demands on the part of union leadership across a whole host of industries that could ultimately be destabilizing for the entire economy. And so that's one of the things that we're focused on at the U.S. Chamber, and one of the things that we're most concerned about.
The administration has been very vocal about support of unions, especially in a year for some very landmark negotiations that have moved forward. And so now from Chamber of Commerce side, when you look at some of the ramifications, as you were mentioning, more long term, what is first on the docket? What should be prioritized here from your perspective as a result of where UAW and where the auto manufacturers are still perhaps miles apart?
Well, let's start with the public policy in the Biden administration. So the administration has adopted a whole of government approach to favoring unionization at any costs. In the middle of August, not reported on widely, but the National Labor Relations Board basically reversed 70 years of precedent and said that unions can become certified to represent workers without actually winning an election to demonstrate that they reflect the will of a majority of employees. You combine that with some of the public policies that we see out of a number of agencies that are using tax dollars through grants and tax credits to basically favor unionized shops. And what you have is this whole government approach that is emboldening the unions to make these type of demands and really creating an imbalance in the management-labor relationship. And it's that imbalance that ultimately is a long-term threat to the economy. Our ask to the administration is, let's maintain balance. Yes, workers should be enjoying higher wages and the fruits of their labor. There's nothing wrong with unions negotiating hard and for good contracts. But this approach to use government to put the thumb on the scale means that we're achieving an unbalanced economy. And that's when, as you all know, bad things start to happen in the economic future.
So, Neil, we have the UAW strike, obviously the Biden administration paying very close attention to that. And we also have what's going on right down in D.C. on Capitol Hill. We're on the brink of a government shutdown if the two sides cannot reach an agreement. We had the House Republicans releasing a short-term bill that would avert a government shutdown until the end of October. What do you think the odds are that we do see some sort of shutdown?
Well, unfortunately, quite high. I think the consensus that's emerging in Washington is that a shutdown is almost inevitable. It's not inevitable. A shutdown is a choice. And the reality is that we are in a moment of divided government. Republicans control the House of Representatives. Democrats control the Senate and the White House. That means that any agreement is going to have to be bipartisan. You're not going to have one side simply achieving all of their demands through holding, keeping the government open as a hostage, if you will. If a shutdown occurs, this will be the fourth in a decade. This is becoming way too common of an occurrence. And it's going to have lots of ripple effects through the economy. People tend to focus on the spending that's all of a sudden stopped or delayed in the case of a shutdown. One of the things that we focus on are all the people who rely on government doing its job so they can do theirs. During the last government shutdown, we heard from lobster fishermen, for example, who couldn't take their boats out because they couldn't get the certificate from the Department of Commerce to be able to operate because the government was shut down. We talked to an innkeeper in Georgia who relied on the National Park Service to make sure that people could get to their end. They lost an entire month's worth of bookings because the government was shut down. So when you think about people who need visas and permits and government certifications to operate, those are the ones who are immediately impacted. And the longer a shutdown goes on, the more time is lost and the more negative consequences for all of those businesses.
Yeah, much more frequently and too frequently, something that we have to continue to evaluate and discuss. Neil Bradley, U.S. Chamber of Commerce, Executive Vice President and Chief Policy Officer. Thanks so much for taking the time this morning.
Thanks for having me.
Certainly. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq market site. It is a busy Monday here. The UN General Assembly gathers today in New York City. An upcoming election in Poland heats up. The U.S. and Iran agree to a prisoner swap, and North Korea's Kim Jong-un is on his way back home from a visit with Putin where he took a train. There's a lot of headlines to keep track of today, but the story that Yahoo Finance's Rick Newman is thinks is worth keeping on your radar: Ukraine. He joins us now with more. Yes, perplexed I was, Rick. Why Ukraine?
Well, we had this news recently about Elon Musk. This goes back to last year, how he supposedly would not turn on Starlink to allow Ukrainians to mount an attack with naval drones off the coast of Crimea. That was a year ago, but guess what has been happening recently is Ukraine has been attacking Russian boats and ships along the Crimean coast and in the Black Sea without Elon Musk's involvement, apparently. So military analysts I follow have been saying that this is a pretty big deal, that Ukraine recently destroyed a major air defense system that protects Ukraine. That allowed them to attack, I think, 4 ships, including a submarine. 2 were docked and 2 were out at sea. And this is a potential turning point in the war, because if Russian naval assets are increasingly vulnerable and open to attack from Ukraine in Crimea, they may have to move those back to Russia. Those ships, some of those ships fire missiles at Ukraine. They do other things to project Russian naval power in the Black Sea. And I know people have kind of lost interest in the Ukraine war because we're not getting any dramatic developments like we did around this time last year. But things are advancing nonetheless. So I've been trying to exhort people: do not stop paying attention to this war. Big things are still happening.
Rick, where does the funding stand? Because we know Ukraine has been pressing President Biden for more funding. I was just reading reports that they're potentially asking now for tens of billions of dollars more. Just the pushback that he's getting from the other side, and exactly what the impact that could have on this war with Russia.
And Ukrainian President Zelensky will be in Washington this week to undermine those claims. Ukraine funding could be affected by what seems to be a likely government shutdown. It could then be resolved. But I think Ukraine will be getting plenty, generally speaking, until the presidential election in 2024, and whether to continue funding Ukraine, both military aid and economic aid, is going to be a significant issue in the election.
All right, Rick Newman, thanks so much for bringing us the latest on that. We'll keep right here on Yahoo Finance. We're live from the Nasdaq market site. We'll be right back.
We keep talking about the student loan repayments coming back. I mean, this is something we've been looking ahead to. It's finally going to be happening as of October. How much of an effect is it really going to have?
I think it's one of those things that's just another data point when it comes to the health of the consumer, and another reason why we could see volatility going into the end of this year. If inflation proves to be stickier, if we start to see more of a deterioration in the employment backdrop, then you're going to see consumers making the decisions that they've been making all year in terms of the nice to have versus need to have, and they're going to focus more on the need to have.
Welcome to Yahoo Finance's Next. I'm Akiko Fujita. Today we are talking about the next phase in the global space race, the race to the moon. Governments around the world are scrambling to stake their place on the lunar surface, but no commercial company has achieved that feat just yet. Now, it's been more than 50 years since the Apollo mission landed the last American aircraft on the surface of the moon, and the renewed interest on the lunar surface has come with an explosive growth in the commercial space industry. The Space Foundation says they have seen large growth every year on year in the global space economy. The most recent space report found that the global space economy reached a total of $546 billion in 2022. By 2040, Morgan Stanley estimates the potential revenue from the global space industry could surpass $1 trillion from $350 billion in 2020. That is an increase of 186%. So, as interest in space exploration grows, companies are bracing for a booming lunar economy. Pittsburgh-based Astrobotic is attempting to become the first commercial space company to achieve a lunar landing. I got a rare look inside the company as part of our original weekly series Next that gives you a glimpse at what the companies we cover every day are planning for the future.
I think the future of the moon is a routine, regular access to the moon. The same way that we're talking about hotels for private citizens in space.
Hotels on the moon?
It will be a little while, but I think that's a possibility sometime in the future.
The future's unfolding at Astrobotic's headquarters in Pittsburgh. Inside this vast facility, researchers are laying the groundwork for a reality once limited to science fiction: human life on the moon.
Hair mask on?
Hair mask on.
One size fits all?
There's a few different sizes.
A small is too big for me. You all ready?
All right.
Astrobotic's ambitions are driven by CEO John Thornton. His lifelong vision taking shape inside a clean room so secure, few outside the company are allowed in.
That is the largest lander of any kind since Apollo, as you're seeing right there. It's going to deliver a 1,000-pound rover that NASA's building called Viper to the pole of the moon to drill for water.
Space landers built here will carry the load for the lunar economy, shuttling cargo from the Earth to the moon.
The amount of precision required and the amount of engineering that's required to get every gram of performance out of this vehicle, it's tremendous.
The Peregrine lander marks the first real test for Astrobotic's technology. It's housed inside the most secure confines of its facility.
We're walking into an area that has less than 10,000 parts per million in dust and debris in the air. So we need to be very, very clean to make sure that our dry skin or our hair or any debris that comes from us doesn't end up on the spacecraft.
The Peregrine is engineered with its own electronics, propulsion, and communication systems. The vehicle will be loaded onto a ULA Vulcan rocket. If it lands successfully, it would mark the first commercial lunar landing in history, beating out their primary competitor, Japan's iSpace.
You talked about Astrobotic's mission being, sort of democratizing access to the moon. Why is it so difficult to get there?
First, you've got to build the spacecraft here on Earth. You've got to get it up into space. That's relatively easy now, especially with the likes of the rise of commercial launch groups like SpaceX, for example, making access to space affordable and routine. But the next big challenge is when you go out to the moon is you have to build a spacecraft that can fly for up to a month or more at a time through space, get out to the moon, drop into lunar orbit, and then descend for a soft landing down on the surface. No private group has so far been successful to land on the surface themselves. We hope to be the first.
Success on that initial landing will pave the way for Astrobotic's next phase, building out the moon's infrastructure. It's part of a $470 billion global industry, largely dominated by the U.S. While satellites and rockets have attracted a bulk of the space investments, infrastructure spending is growing.
Most people think of space as NASA and the government agencies, but less than 20% of that $470 billion is actually government activity. So the rise of commercial space is thriving right now and only projected to continue to grow. And the moon is going to play a very important part of that.
Playing in that space requires navigating the moon's extremes.
This is one of those rooms they use to simulate light in space. That light you see there is what they call Earthshine. It's essentially the reflection of the light through the Earth's atmosphere. And that really bright light you see back there is the sunlight. And they do this to make sure that their software can operate in these conditions.
The lighting conditions in space are very challenging. There's no atmosphere that will diffuse the light and make it change directions and kind of even it out. And dark in space is very dark. Like there's zero light reflected around.
The tests are done to ensure these robots can navigate the lunar surface in spite of that. This one, known as Cube Rover, is designed to carry payloads across challenging terrain filled with tiny particles known as moon dust.
So this is pretty similar to what we know as regolith, which is on the lunar surface. And it kind of feels like sand.
One of the biggest issues on the moon is the dust. It's almost talcum powder-like sized. It's very sticky. It's very electrostatically charged. It sticks to stuff like static. And that can get on all kinds of things and cause all kinds of problems.
To address that, Jay Eckerd's teams built a wireless charger that can operate even with a moon dust storm, giving rovers and landers a direct source of power.
So the expectation is that you take this to the moon, you're going to get all the regolith in there, but you want to make sure that it's still transferring power.
That's right, because if you run out of power on the moon, that's game over. You don't get to go up there and plug it in or bring in extra batteries.
To ensure reliable access to power, Astrobotic's also building out a portable grid that provides solar energy. This Luna grid will act as a type of mini gas station, generating and distributing power. That's especially critical during the lunar night, which spans 14 days.
Gets down to liquid nitrogen cold for 2 weeks. And that kills a lot of spacecraft. So if you can survive that night, you can then do multiple year-long expeditions on the surface of the moon.
It's a future Astrobotic is working closely with NASA on. The company secured multiple contracts valued at $450 million. Next year, this Griffin lander is set to carry NASA's own rover, Viper, as part of the Artemis mission. That robot will be tasked with looking for water in the deepest craters of the moon. If they're successful, Thornton says it will open the floodgates for space exploration.
So water at the poles of the moon could be like oil it was here on Earth for the beginnings of our space travel. So that could be how we go back and forth from the moon. That could be how we refuel our spacecraft to go to Mars and other deep space destinations. But it all starts right here with our nearest neighbor, the moon.
That 240,000-mile journey from the Earth to the moon, unlocking a new vision that could propel humans into the next frontier.
All right, Akiko, that was incredible. I mean, we were sitting here watching that package, and I mean, if there are any takeaways about like how close we are to making some of these dreams, some of these deep scientific discoveries a reality, what were you able to take away from that?
Yeah, I can't stress enough that when you talk about the space economy, so much attention has been on the tourism aspect of it. But I would argue that's probably the least interesting part of it all, largely because we're talking about building a whole nother economy on the surface of the moon. You saw in that piece there, talking about building power grids, potentially roads. And then from there, we've already started to see the potential of space manufacturing. All of that really a setup for potential life on the moon. And we're talking right now about this global race that has been happening. There was a lot of interest recently, several weeks ago, when India became the first country to land on the south pole of the moon. That's critical because that's where the natural resources is seen as being. Water would unlock, as I said in that piece, for the potential for longer term stays on the moon. So that's really been the focus for governments. As you saw in the piece there, Astrobotic, though, is trying to become the first commercial company to land on the surface of the moon. And they're taking a lot of companies, a lot of industries with them, because you saw that lander there. Sort of think about it as kind of like a FedEx type of thing, where essentially you've got the lander there. You as a company, as a government, can place things on that lander to get to the surface of the moon, so it can really unlock so much potential in terms of exploration and scientific discovery.
Yeah, Nikiko, what does the timeline look like for that when we talk about just the jumping off point for future exploration? What exactly this can do for that? You mentioned the fact that there's so many companies that are investing or involved in this space right now, and it's still, I would say, at the early stages of it. But when we talk about what the future could look like, whether that's 50, 100 years out, any idea as to what maybe we should be bracing for if we're still around?
Yeah, it's incredible to think that we're talking about exploring the moon 50 years after the Apollo mission. So much time has passed, but now that commercial companies are involved, it has really accelerated the timeline. You're talking about the next phase here. We mentioned discovering the poles of the moon. After that will come the manned missions to the moon. You've got NASA and the Artemis mission. Next year, you've got a crewed mission that will come within the vicinity of the moon. The following year, 2025, is what we're looking at in terms of a timeline for the first landing, humans landing on the lunar surface since the Apollo missions. Then, of course, the way to think about the moon is really as a jumping off point. So we're talking about moon exploration first, building out the infrastructure, but the long-term goal here is exploring Mars. You've heard the likes of Elon Musk talk about this before, but the reason they want to get the moon set up first is essentially so that it's less travel time. You don't necessarily have to go from the Earth all the way to Mars. You can set up sort of a base on the moon to be able to be a jumping off point for other planets that will be explored in the long term.
Akiko, great stuff. Thank you so much for that report and, of course, for that rare look inside Astrobotic. Well, renewed ambitions in space have led to a surge in private capital pouring into the industry. From SpaceX to Blue Origin and beyond, commercial companies are racing to capitalize on those opportunities. Now, Morgan Stanley estimating that the global space race is going to reach $1 trillion in annual revenue by 2040. So where should you be putting your money in this growing market? Brad and I sat down with Chad Anderson, the founder and managing partner at Space Capital and author of The Space Economy, to break it all down for us. Let's listen to what he had to say.
You know, I think when most people think about space, they think about the Apollo moon landings, the International Space Station, sort of these grand human achievements, but they don't think about the entrepreneurs that are transforming every major industry here on Earth. But that's the opportunity that we're really focused on as VC investors in this space. And space technologies are the invisible backbone of the world's largest industries today. GPS, geospatial intelligence, satellite communications are powering every major industry that we rely on. It is becoming increasingly important and critical. There's a bill in the House right now to deem it critical national infrastructure. Space technologies are essential to our economic stability and our national security. And so the idea is to think about this as much, much broader than just rockets and satellite hardware. The opportunity here is much, much greater than that.
So when you think about the industries that are going to be most immediately impacted by space and further investment, I mean, naturally we think about some of the things that you were talking about with telecoms and our connectivity, but even beyond that, agriculture is something that you talk about as well. What are all the different ways that investors, but the everyday citizen, can expect their life to change as a result of furthering investment in space too?
Yeah, I mean, the opportunity here is massive, but just to give you a few ideas of opportunities for investors that are outside of the traditional sort of SpaceX and the other big players, we've got, Satellogic is a publicly listed company. They have Earth imaging satellites that are producing some very high resolution data on a very regular basis. They've just announced a partnership at the conference in Paris with one of our portfolio companies, Skywatch, that is bringing that data together with other data sets from Earth observation satellites, structuring it and making it really easily accessible through an API, which is now feeding into enterprise workflows. So it is feeding directly into insurance company underwriters, for example, disaster relief. This type of imagery is being used for precision farming, like you mentioned. But this is a really valuable data set. You can kind of think about it as similar to GPS, right? And we've written the GPS playbook, and that sort of informs everything that we do. You've got these satellites that are producing this really valuable data. It's now being harnessed. It's now on the cloud and being structured and organized and distributing out into all of these unique applications. You can think of the Ubers and Lyfts and the Instacarts and everything else that we rely on when it comes to GPS. The same sort of thing is happening in geospatial intelligence today, not to mention satellite communications and all of the interesting applications that are being built on top of this new capability that SpaceX's Starlink and Amazon's Kuiper, their internet satellite communications satellites are enabling.
Chad, tell us a little bit more specifically about that playbook. When you're out there, when you're looking at companies, when you're looking at potential investment opportunities, what are maybe the top 3 things that you're looking for to identify that attractive investment?
Yeah, so we're investing at the earliest stage. We're getting in as pretty much the first institutional check into a company. So about 5 to 7 years away from the public markets, but what we're looking for at that stage is really founders who understand the technology that they're working with. They understand the infrastructure, the satellite hardware, the market in which they're operating in. So they bring some of that experience to the table, because there are some nuances here that make this a unique category to be investing in and to be building innovative solutions in. So having that background and that understanding is really, really important. Also, their ability to navigate a rapidly changing landscape. I mean, all of the growth that we've seen in the space economy has happened over the last little over decade, right? I mean, it wasn't that long ago that we saw the market was completely government-led. There was the government and the government's handful of defense contractors, and that was it. Until SpaceX, not only did they bring a superior technical solution to the market, but they also had to fight for the privilege, and they had to compete for contracts and sue the customers to win those contracts and sort of break that deadlock that the defense contractors and the antibodies of innovation sort of were out to get them, and they were able to get past all of that. And so we start to think about the amount of innovation that's happened since then. We are tracking $280 billion of investment capital into 1,800 unique space companies over the last 10 years, and that's up from essentially 0 prior to SpaceX. And we are now here sitting today looking at possibly next month, Starship having their first orbital launch, and that vehicle promises to have as much of an impact as their previous vehicle did, that's given us, and delivered all of this innovation over the last 10 years.
When we think about some of that space investment and that innovation, it's come with, or at least orbited around, a few specific names. It's been Jeff Bezos, it's been Elon Musk, it's been Sir Richard Branson. Yeah. Are there any new figures that are set to really break into that squad of, if you will, as it's been called in at least one book out there, space barons?
Yeah, I mean, there is a lot of attention put on these billionaires that were sort of the front runners here and sort of helped, supply that initial capital that was needed to break in. And these companies get lumped together, right? SpaceX, Blue Origin, Virgin Galactic, but they're all very different. Virgin Galactic has a suborbital space plane. It is an experience to go up and experience weightlessness for a couple of minutes. Blue Origin has big ambitions. Bezos' company has big ambitions to do lots of things, space stations, heavy launch. But at the moment, they're only doing suborbital space tourism as well, where they launch up and you get a couple of minutes of weightlessness. SpaceX is on a whole nother level. They are the apex player in the space economy, without a doubt. They're so far ahead that it doesn't really matter who's second. And they're taking us to orbit, they're launching satellites, they're launching humans for NASA. They are our best chance at getting to the moon and landing humans on the moon and setting up an outpost there. So our immediate terrestrial earthly needs are being met by SpaceX and our future ambitions as well.
And that was Chad Anderson, Space Capital founder and author of The Space Economy. We've got much more of your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
We're live with you from the Nasdaq market site. Let's do a quick check of the market sponsored by Tasty Trade. About an hour into the trading day, we're not too far from the flat line. We're looking at the Dow under a bit of pressure, off just about 15 points here, but the S&P and Nasdaq barely holding on to gains. The Nasdaq up about 0.1%. Taking a look at some of the sector action, consumer discretionary, real estate among the worst performers early in the trading day. Energy, though, outperforming once again as we see crude a tick higher. We have the XLE energy sector up just about 0.7%.
Well, let's take a look at some of the stocks that are moving the market this morning. We've got our very own Jared Blickery, who is here in studio with us at the Nasdaq market site. Hey, Jared.
Thank you, Brad. Well, let's take a look at the overall market. As you were saying, a mixed market today. The small caps are leading down 0.2%, but the Dow just kind of oscillating around the unchanged. So is the S&P 500. And by the way, the Nasdaq has been in the green for most of the day. But we're taking a look at the Nasdaq 100 heat map here. Overall, Apple up nicely off of that potential support that I was looking at. Here's a 3-month chart, and you can see just kind of bouncing off these levels that we tested from earlier in August. Also taking a look at Tesla here, it's down over 2.5%. Now, the news on this stock, Goldman Sachs is revising their price targets and their estimations for EPS for the current year, 2024 or 2023 and 2024. They're worried about gross margin and reduced average selling price. So Tesla under a little bit of a pressure here, but over the last 3 months, I'd say they're treading water. Here's a year-to-date look, and you can see how kind of a bifurcated year. You had one trading range down here until the middle of May, and then a new trading range until now. So no big news there. Taking a look at the sector action, as you said, Shauna, the energy sector leading the way. Number 2 is tech. So we were seeing some early weakness in chips and software. Let's take a look what's happening there. Here's software in a lot more green than we have red. That's a change from earlier in the day. CrowdStrike up 1.3%. Atlassian up about 1.5%. And then here's semiconductors. This was more red than green earlier too. So we're seeing some of these names pick up. Applied Materials 1.78% and Micron 1.37%. Energy still the leader of the day. We'll just pick out some names here. Marathon up 2%. And here's a look at what that stock has done year to date, 35%. But concomitant with the rally in crude oil we have seen over the last couple of months, that's when it has really accelerated, guys.
Jared, I know you're also closely watching the U.S. dollar here. That's going to be a focal point here for investors ahead of the Fed and also after the Fed meeting this week. But what are we seeing this morning?
Yeah, that's right. This is actually the 10-year T-note behind me. So let me just pull up the U.S. dollar. And we're going to see that's ticking down ever so fractionally. But it's actually camping out in the upper end of its range that we see over the last 3 months. Here is a year-to-date look. And you can see the strength in the dollar is really precipitous here, although we are at a point that we would see some natural resistance. So we'll have to see what comes of that. I want to go back to the 10-year because 10-year is also camping out near record highs or near recent highs. However, you'd have to go back all the way to 2007 to see a higher print. So some pretty heady action there, as you mentioned, Shauna, ahead of the Fed meeting, which we are tracking closely, especially this week.
All right, Jared, thanks. Well, it's day 4 of the United Auto Workers strike against the big 3 Detroit automakers, and things are escalating. UAW President Shawn Fain recently saying that if the union does not get better offers, they're going to, quote, amp this thing up even more. On the other hand, the companies are announcing temporary layoffs, with Ford telling 600 workers not to report to work at a Michigan assembly plant, and 2,000 GM workers in Kansas are expected to be out of work this week. We want to discuss what this means for the EV transition. For that, we want to bring in Nathan Bomey, Axios business reporter, as well as Micheline Maynard, a journalist and author. Great to have you both here. So let's just start when we talk about the fact that this could potentially delay the transition that we could see to EVs. Nathan, how imminent, how real is that risk?
I don't think it's imminent, but it certainly is a risk in the long term. If the automakers come out of this hobbled, they'll be delayed on all products, and that will certainly affect electric vehicles. I think their long-term concern for the automakers is that they come out of this with higher labor costs, which makes it more difficult to make EVs at a price point in which people can afford. But the UAW says that the automakers can afford it because they have profits that they've been racking up over the last several years, and that it's time to give some of that back.
Micheline, how would this create pressure for the supplier channels that these automakers have as well, given the fact that if they have to make sure that they're paying a higher wage to so much of the union and for the workers that are negotiating and realizing how their jobs are going to change. On the other side of this, automakers are going to have to try and figure out where they can offset some of those wage increases as well.
Right. I think the wage issue is very important for both the main automakers and the suppliers, especially some of the suppliers are unionized, but a lot of them are not. And so there will be pressure on the car companies to cut costs wherever they can. And whenever they've cut costs in the past, they've looked offshore in order to find cheaper sources of materials, parts, and labor.
Nathan, how much of an advantage does Tesla have in a situation like this?
Well, they already have an advantage of about maybe $15 or $20 an hour, according to the companies. That's on labor costs. And so the question is, how much wider is that gap going to grow? So, Tesla has some other advantages. Obviously, the fact that they have, been way ahead on EVs. And so they're getting more and more efficient in the manufacturing process. And so that's also an advantage. But, I think that certainly this is going to advantage Elon Musk in one way or another. But GM, Ford, and Stellantis certainly have significant electric vehicle programs, and they've made a lot of progress. But right now they're pretty concerned about losing an edge. The question here is which side can extract blood first. I think that they both kind of have to show their constituents that they fought really hard, that they've taken a bite out of the other side. And it's not until that they can prove to their people that they've done that this will probably be resolved.
Micheline, we're looking at a far more robotic, even, dare I say, augmented intelligence type of facility that's producing so many of these millions of vehicles across the auto manufacturing landscape. And so how is that coming up, or how is that expected to also play a role within these negotiations?
Oh, absolutely. I think one of the things that the UAW is very concerned about is job security, and not only job security for the veteran workers, because they've been offered buyouts in the past. And probably what will come out of this set of negotiations is, if you want to take a buyout, if you have enough seniority, this might be a good time to take one. But they are very concerned about the younger workers that have been hired. So just to give you an example, a veteran worker makes about $32 an hour in wages. The younger workers make about $17 an hour in wages. And what the union is asking for is for those younger workers to be bumped up faster. But then they run into this prospect that we will have AI and we will have more robotics, and the car companies are going to figure out ways to streamline things. And remember, when you have electric vehicles, you're not putting engines in them, and engines take a lot of components. And so that's an area where the UAW could easily be looking at job losses.
Nathan, I know you've been reporting on this for some time. You've been talking to a number of players within the industry. What are you hearing just in terms of how long the strike could potentially go on for, and maybe some of the asks that the automakers would be a little bit more open to when they're trying to reach some sort of agreement?
I mean, it's anybody's guess, but I think it's very difficult to see how this gets resolved within days. It feels more like weeks. And I mean, I can't rule out months because the two sides just seem so far apart on benefits in particular. I think on wages, they're starting to get closer. The UAW, I think, now wants a 36% pay increase, and the automakers are at 20 or 21%. That gap is starting to shrink, but benefits is where they're really far apart. I mean, the UAW wants a return to more traditional pensions and retiree health care, and the automakers say that's absolutely not going to work.
And so just kind of broad strokes here, the impact to the economy that we may see as a result of an extended shutdown or strike, especially given that we had the Teamsters last week also step up, throw their hat in the rings and say, well, hey, we're not going to cross the picket lines either, Nathan. What kind of anticipated impact does that spell out?
I think in the immediate term, probably not a big impact because we're only talking about 3 plants. We know that there could be an additional plant for GM that goes offline because of the first 3. But I think the impact starts to widen considerably if the UAW expands the strike, which they've threatened to do.
Micheline, we know the Biden administration tapping Gene Sperling here, helping to try to really accelerate some of these talks now for quite some time. We haven't seen too much movement there. Do you think we are going to see maybe a different tone from the Biden administration as they travel to Detroit to try to get a better handle of the situation?
Well, I was very surprised to see the president weigh in on the strike so early. We've definitely had presidents in the past who expressed concern, but they haven't sent advisors to Detroit. Actually, Gene Sperling lives here, so it isn't a very far trip for him to come. But to tap 2 advisors to oversee these negotiations, or at least kind of sit on the sidelines and watch them, I mean, that's real pressure from a presidential administration. And so I have a sense that I agree with Nathan that this could drag on for a while, but I don't think it's going to drag on months. I think that there's too much political danger for the administration if this goes on. And the other thing to remember is a lot of unions around the country are expressing solidarity. People are showing up to picket, sort of friendly, join the picket lines. And so if we see a union movement across the country that really puts pressure on the 2 sides to settle, I think that will be a factor as well.
If we did see a broader union movement, where else could this kind of overflow into further from here? Because, I mean, we've already seen large negotiations and strikes also have to come forward, whether that be on the entertainment side, whether that be in the auto side, several different capacities, even as we're thinking about fulfillment, areas where there hadn't been unionization. Where do you believe, Micheline, that there could be more of an effort derivative of what we're seeing play out right now?
This is a real year for the labor movement. And I have to be honest, I mean, I'm a 3rd generation union member. I'm a member of the News Guild and the Lecturers Union at the University of Michigan. And even as somebody who's watched labor basically my whole career, I've never seen anything like this. And so I think the sympathy of labor movement members, especially younger people, if you look at the Starbucks baristas and how much sympathy they've gotten, I mean, this could spread in a number of different directions. And it's just really fascinating to watch. I've never seen anything like this before.
All right, Nathan Bomey and Micheline Maynard, thank you both so much for taking the time here today and discuss this very important topic. We'll see how much longer this plays out for. We appreciate the time.
Thank you.
Thank you.
Thanks. Everyone, we've got all your markets action straight ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Live from the Nasdaq market site in New York City, you're watching Yahoo Finance. Brad Smith here with Shauna Smith. Lots on the docket this week beyond the back and forth over the UAW's unprecedented strike. Let's get the landscape with Yahoo Finance's Josh Schaefer. Josh, do we have the excitement meter yet? Please do not.
Brad, I don't
disappoint.
have the physical excitement meter, but I can tell you the excitement is through the roof. It's a Fed week. Come on.
There we go.
We're fired up.
great.
We're fired up on a Monday morning, and I want to take a look at what we do have on the docket this week. A lot of home builder data, a lot of housing data. That home builder confidence index came in lower than expected today, surprising the street a little bit. So it'll be interesting to see what we see in the housing sector for the rest of the week. I want to highlight a couple other things, and then we'll get to the Fed because that's sort of the fun stuff, right? We're going to have jobless claims on Thursday. We've been watching that labor market pretty closely. And then we're also going to have FedEx earnings and General Mills on Thursday, really kind of the only highlights from a corporate side of things when we're talking about earnings. We're also going to get some updates on services and manufacturing come Friday. But again, guys, Wednesday is the big day here. And what we're looking for on Wednesday right now, it's about a 97% chance the Federal Reserve doesn't raise interest rates on Wednesday. So the most interesting thing I think to watch is going to be that summary of economic projections, that dot plot. And where does that move for the rest of the year? Are Federal Reserve officials still pricing in one more rate hike for this year? And when are we going to start seeing a cut? We're looking closely at what we see in 2024 and the projections for interest rates in 2024. That's going to be the big thing to watch. That's on Wednesday. That's the day we're excited about today. But it's only Monday, so plenty to come this week, guys. Maybe we'll get something more exciting that we don't quite see coming yet.
Well, Josh, we've also got maybe something that's a little bit exciting, especially for those who have been waiting to upgrade. Apple is going to start getting the iPhone pre-orders. You're going to be able to start doing that later on this week. What are the expectations there?
Yeah, Shauna, so the street coming in a little bit surprised with how well demand has been for iPhone sales and pre-sales so far. Been interesting to see these lead times is what I have next to me. So this is a chart from Bank of America. And when you take a look all the way over here, you can see in purple, you have iPhone 15 compared to the iPhone 14 Pro. So lead times is how long it's going to take that phone to ship. So lead time's still a little bit far out for the 15 is what analysts said, but better than what we saw for the 14. Interesting to think about when you think about any potential supply chain disruptions and what people are buying. Speaking of what people are buying, street analysts right now looking at what people have been searching for on Apple's website trying to buy, seems like that 15 Pro Max, that high-end model is where people are buying right now. Should note Apple shares were up earlier this morning as multiple analysts on the street were breaking down this data. So it seems like overall, people relatively happy that those Apple customers are going for those expensive phones. Of course, we're going for those expensive phones, right, guys? They got us in the ecosystem. I always feel like I'm buying up when it comes to the iPhone.
I know. It's hard to say no when you know that there's another model that's just a bit better if you pay $100, $200, $300 more. But that would be very, very good news there for Apple for their margins. All right, Josh Schaefer, great stuff. Thanks. We've got all your markets action ahead live from the Nasdaq market site. Keep it right here on Yahoo Finance.
Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it.
The first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment.
President Biden and his administration is committed to taking action in order to relieve student debt. The president has also announced a Plan B under the Higher Education Act and will hopefully be able to provide borrowers even more relief.
Because we've had such a long break, so a lot of people don't even know exactly how much they owe, who their lender is. And so for some people, it starts with answering those basic questions.
The cost of attaining a higher education degree has become unaffordable and unattainable. And so we really do need to look at common sense solutions, ensuring that states are able to adequately fund their higher education.
Women earn degrees at a higher rate. They're enrolled more in college. So they've taken on more degrees. They've taken on more debt. Then they emerge with a degree and they are earning less. And unfortunately, it takes them longer to pay off that debt.
The president is trying to put into place things that will help people who go to college. And we should be really helping people people go to college and doing it in an affordable way.
I was a high school math teacher right out of college, and I got my first contract for $29,000 and thought it was like $1 million. For most folks, they know today that not that much, and you can't actually kind of afford to live off that money. Really kind of contributed to feeling a little bamboozled kind of by the system itself.
I think the number one thing is, generally speaking, we tell people not to fall victim to people calling you and asking you for advice. If it sounds too good to be true, it usually is too good to be true.
Everybody thought that student loans of all stripes persist through bankruptcy, but in fact, certain private student loans do not. And we brought a lawsuit to try to stop Navient from collecting on those loans for thousands of people, and we're successful.
What we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt. What's the long-term return on investment? And that's what folks are asking.
So the real question to ask isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself.
We have a survey at Prince Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college.
For loan borrowers, they may not feel that the loan itself is worth it, but the education is.
The education is really important, but people are going to have to start asking, is it even worth taking out these loans because it's just so expensive?
Home builders are losing confidence. The National Association of Home Builders Index fell for a second month in a row in September, slipping to its lowest level since April. Now the decline coming as mortgage rates remain above 7%. For more on this, I want to bring in Yahoo Finance reporter Danny Romero. Danny.
Shauna, home builders are not feeling so upbeat anymore, and the confidence is dropped to the lowest level since April. That's what the National Association of Home Builders reported, and this really reflects the uptick in rising mortgage rates, which have hovered around that 7% for about a month now, hindering affordability, plus the rising costs of material goods, labor. This is all weakening the enthusiasm that home builders had been feeling since the beginning of the year. Another point to highlight is that the mortgage rate shock is really affecting home builders and causing them to slash home prices to boost some of those sales. 32% of home builders reported that they slashed home prices in September. The average discount was around 6%. Plus, 59% of home builders offered some kind of incentive. That is more than any other month since April, really highlighting that mortgage rates are taking a toll not only on home builders, but also on consumer demand, Shauna.
Yeah, so what does this latest reading mean for first-time home buyers?
Builders have been riding so high the fact that the resale market has been muted. So they've really refocused their attention on first-time home buyers. And the NAHB reported that 42% of new single-family home buyers year-to-date were first-time home buyers. So that's really signaling who the new customer is for these home builders. And that's also been something that not only have they been slashing home prices, offering incentives, those mortgage rate buy downs, especially they look really attractive when mortgage rates are hovering around that 7%. But really, it's really highlighting who the new customer is, and it's that first time home buyer, that entry level home buyer. Brad.
Yeah, no, this is significant here. A fall of 5 points during September, following a 6-point drop in August. A huge reading, and no doubt going to catch the attention of some investors out there looking at this space in a week where we're also expecting some earnings from KB Homes as well. Thanks so much for joining us here this morning. Yahoo Finance reporter Danny Romero. Thanks, Danny. Well, we've got all your markets action ahead live from the Nasdaq market site. Stay tuned if you're watching Yahoo Finance. You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Welcome back, everyone. You're watching Yahoo Finance Live. We are live from the Nasdaq market site where the IPO market feels hotter than ever here. But we got to talk about a few ones. Of course, last week was all about ARM. But this week, we're going to be focusing on a few other ones. Instacart and Klaviyo as well. Klaviyo raised the target for its upcoming IPO in a filing this morning to $27 to $29 per share. That's the new range. That's up from the previously stated $25 to $27 per share range. Now, this move comes just days after Instacart raised its price range after ARM Holdings' stellar debut. So the IPO market here in 2023 trying to find some signs of footing, at least here, late in the game.
Yeah, and it was a very strong debut from ARM, like you were just saying. We saw shares pop, just about 25% in its first day of trading. Pulled back just a bit on Friday, but still up about 20% from where the company priced. So clearly a huge demand here for ARM, lots of success, of course, and that led Instacart to raise its valuation here, what they're seeking to raise when it prices tonight. And then, of course, we're going to hear from Klaviyo tomorrow. So there is a lot riding on these next couple of debuts, whether or not we'll see that momentum carry through with Instacart with its first day of trading tomorrow and then Klaviyo later this week. What exactly that's going to do for future IPO activity. There has been pretty much general consensus that if we do see three very strong debuts, maybe that's going to be enough here to thaw some of the IPO freeze that we have seen ever since, last 18 months at least, 19 months. We haven't seen much activity at all.
Look, I'm excited. For anybody that's tracking at home and trying to keep tabs on some IPO trivia, if you will, here's a few things just throw your way real quick. Instacart actually is a company named Maple Bear at the end of the day. Maple Bear Inc. is the parent company and the company that's essentially taking Instacart public there. And interesting here, particularly as the leading grocery technology partner here to about 1,400 retail banners representing 85% of the U.S. grocery market. So that for your Instacart trivia there, Maple Bear, may I say. Also here, when we talk about Klaviyo, you should remember that this is a company that has total revenue base right now of about $585 million. They saw revenue growth over the last 12 months, ending June 30th at about 56.5% there. And they've got about 1,400 customers that are over this $40K annualized recurring revenue. So how can they continue to sell into that portfolio and client base? That is going to be key for them to communicate to the street. Total customers of about 130,000 plus to their benefit right now.
Certainly. Well, we will see. We know Instacart has put up pretty impressive numbers when it comes to revenue, their plans here for the future. So we'll see whether or not that excitement holds tomorrow during the first day of trading. All right, let's do a quick check of the markets here before we let you go. The Dow still in positive territory, just barely right above the flat line, up about 18 points. The S&P holding on to gains. We've got the Nasdaq, though, trading just to the downside, right below the flat line. That does it for us today, live from the Nasdaq market site. Rochelle Akufo will have you for the next hour. Have a great day.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The UAW strike against the big three automakers enters its fourth day. The union's head warns, quote, if we don't get better offers, we're going to have to amp this thing up even more. And House Republicans release a bill to avoid a government shutdown on October 1st. Their opening gambit will likely be rejected by the Democratic-led Senate. So then what? We'll get into that debate this morning. And we'll talk tech with some notable leadership changes at Microsoft and why SoftBank could be looking to expand its AI footprint in a big way. But first, let's take a look at the major indices and how they're faring this morning. Looking at a mixed picture here, we see the Dow here still under pressure, but ever so slightly, been reaching for daylight this morning. The S&P 500, they're also just barely in the green as well. Nasdaq relatively flat as well. We're seeing energy the strongest showing this morning sector-wise. Consumer discretionary is the one under pressure at the moment in the S&P. Let's also take a look at what we're seeing in the Treasury market, the calm before the storm before we hear from the FOMC later on this week. As we're taking a look here at some of the Treasury yields there, we'll have those for you just in a minute. Well, following the European Central Bank's rate hike to a record 4%, economists are anticipating that central banks are near or at their peak. Here with what we can expect from central banks this week is Yahoo Finance reporter Ines Ferre. Hey, Ines.
Hey, Rochelle. Well, let's start with the Fed. The market anticipates that the Federal Reserve is going to hold rates steady at the conclusion of this week's meeting, but it's leaving the door open for one more rate hike this year. Now, a Reuters poll shows about 20% of economists expect one more rate increase this year. Of those polled, a majority saw rate cuts sometime next year. Now, Fed Chair Jerome Powell has repeatedly talked about higher for longer, meaning that the markets may have to get used to the idea of staying at the current Fed funds rate level for a longer period of time. And one of the Fed's recent forecasts doesn't see inflation coming down to the 2% target until 2025. Now, several other major central banks have been following the Fed's lead in order to combat inflation and protect their own currency, by the way. The Bank of England is likely to hike interest rates one more time this week, possibly the last one this year. Both Citi and Goldman Sachs believe this Thursday's decision will be the last hike for the BOE. Meanwhile, last week, the European Central Bank hiked its key rate to a record 4%. The increase was accompanied with a statement that read in part that rates are at levels that, if maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to the target. Now, Deutsche Bank analysts don't see rate cuts for the ECB until at the earliest September 2024. And one of the challenges for getting inflation down, of course, are oil prices, which have been on a steady rise for the past 3 months, on pace for their largest quarterly increase since Russia's invasion of Ukraine last year. Rochelle?
All right, thank you so much. Our very own Ines Ferre there for us. All right, well, stocks are mixed this morning as investors look ahead to Wednesday's Federal Reserve meeting. Most anticipated a hawkish pause from the FOMC, but the uncertainty is causing some market volatility. So how can you build wealth in this sort of market environment? Joining us now with that answer is Anthony Saccaro, Providence Financial and Insurance Services President. Thank you so much for joining me this morning. So, I mean, as we're taking a look at how Treasuries are faring this morning, they're still in the green. They're still above that key 4% mark for the 10-year as well. But obviously a lot of uncertainty about what the Fed is going to do. How do you build wealth depending on your time horizon when you're looking at retirement?
Well, uncertainty is the key word for sure. And I think stocks over the long run, if you're in the accumulation phase of life, you have more than 10 years to retirement, are still going to be the long-term strategy, the best strategy for building wealth. But we don't want to forget that with bonds so low at this point because of the high interest rate increases over the last couple of years, that it's not a bad time to add bonds into the mix, not only for the consistent yield, but also for the potential capital appreciation. That's something that you haven't been able to do in decades because bond prices have been so high as yields have just remained stubbornly low. Now, the fact is, though, that even when it comes to the stock market, I like my clients to be in a position where they can win no matter what. And in order to do that, you have to be in dividend-paying stocks. What that allows you to do is that allows you to get paid to wait. You know, the next 5 or 10 years may be choppy in the market. There's a lot of analysts out there that think that over the next decade, it could be flat. We've seen lots of 10-year periods in the market where the period's flat. And if you're in growth stock, then you're flat. But if you're in dividend stocks, at least you can dollar cost average those dividends back in so that you're getting paid to wait. You have the ability to use that dollar cost averaging math to your advantage, regardless of whether the market stays flat. And I think that's a great strategy for if you're younger.
Now, if you're older and say, you're looking ahead to retire for 2024, not knowing what's going to happen in terms of Fed action there, how does that approach change?
Yeah, great question. And that's a question that we get all the time at Providence Financial because we do specialize in working with retirees. And the answer is this. I want my clients, my retired clients, to be invested in investments that are going to give them interest and dividends to be able to live off of. A lot of people don't understand interest and dividends. You can spend your interest and dividends every single year without ever having to cannibalize your principal. If you're taking out 4%, let's say, of your portfolio, which is a common number, if you're invested in growth stocks or mutual funds, you're having to sell shares, which means next month you got to sell more shares, and next year you have to sell more shares. And in a flat market, that's just horrible. You're cannibalizing your principal. Whereas if you're living off of interest and dividends, you're not having to cannibalize your principal. You're never having to worry about running out of money. So for the income that they need from their portfolio, I want them to set aside enough money to live off the interest and dividends. And once they've got that covered, their income coming from interest and dividends, then they can play with the rest of it. They can take the rest of it and put it into some other things that give them potential for growth. So that's how my retired clients are playing it. I think that makes sense for most retirees out there.
And then for those who are perhaps mid-career or early career, who have a longer time horizon here, you're looking at things like inflation, you're not sure how long it's going to be this high for. How do you weight your portfolio differently if you're, say, mid-career or just starting your career?
Yeah, great question. You're certainly going to weight it more heavily towards stocks. I think the dividend stocks, as mentioned before, is probably the great way to go. But you could also go a little more heavier into bonds at this point with the income because you've got that capital appreciation. So the typical 60-40 portfolio is something that has had a lot of controversy around it. Does it work? Does it not work? I would suggest that if someone has 20 or 30 years to go in retirement, my recommendation in the past is generally going to be 80 or 90% dividend paying equities. I think over a 30-year period, that's where you're going to get the most bang for your buck. And because you have such a long time horizon, all the odds are in your favor. But today, because yields are so high, because bonds have been beaten down and are at low levels, I think a 60-40 for now even works for the younger person, with the idea that when the Federal Reserve lowers rates, and bonds increase in value, then you can reallocate back to a higher allocation of dividend-paying stock at that point.
And Anthony, obviously, as we look at the economic picture, we're seeing, wage growth starting to moderate a little bit. The very tight job market's, starting to see some cracks there, and people are having to prioritize in different ways. I mean, according to statistics, about 57% of people last year don't even have a financial advisor. How do you start structuring your portfolio when you're sort of looking at some of these changes in the workforce? And how do you adapt it as you see some of these changes from the Fed and from the economy?
Yeah, so I think that the Fed, and all the odds are that the Fed's going to hold steady this next FOMC meeting. And I even think there's a good possibility that they hold steady in the following meeting after that, but we don't know. The fact is that if you have a long time horizon, what you need to understand is that it doesn't matter what they do. If your strategy is dollar cost averaging, and that's just buying the same thing over and over again, and if you're dollar cost averaging, keep doing that. Don't change. You don't want to be in a position to where the market volatility spooks you and now you deviate from your plan. But in order to do that, you have to have a plan. And your plan cannot be that the market's going to go up 8% a year for the next 5 years or 10 years. That's not a plan. The plan has to include what happens if this, what happens if this. That's the whole point of the plan. If you plan to drive from California to Florida and the road is closed, you have to know how you're going to deviate. You don't make the decisions at the moment the market corrects or the moment we go into a recession. That all has to be built into the plan ahead of time. No good decisions happen when you panic. And if you have a plan and you know what you're going to do ahead of time, I'm going to suggest that you don't panic because whatever you do is probably going to be wrong.
Indeed. I mean, everyone says, timing the market, it's a fool's errand because obviously anything could sort of shake it up. I do want to ask you, in terms of some of the sectors that you think offer the best sort of dividends, some of the sectors here, which ones are the standouts?
Well, the real estate sector is a stand-up because it does do well at inflation. You generally can go ahead and get a lot of dividends from that real estate sector as well, too. And so that's an area that we would focus. But there's a lot of common stocks in general that are going to pay high dividends. There's even ETFs out there that are going to pay high dividends as well. But I would focus on the individual dividend payers. If you are maybe less than $250,000 or $300,000 in your portfolio, I really think mutual funds or dividend-paying ETFs is probably where you need to be. It's hard to diversify a portfolio under that in individuals. But when you get over those levels, working with a financial advisor that specializes in income like we do, I think that makes a lot of sense. Specializing in dividend-paying stock once you get over $250,000 in the amount that you can invest.
We appreciate you giving us all those insights. Hopefully people take heed or at least start to get some sort of plan together. A big thank you there, Anthony Saccaro, Providence Financial and Insurance Services President. Thanks so much.
Thank you, Rochelle.
All right, well, I've got my eye on Bitcoin today, up above $27,000, its highest level since August 31st. And this comes after the cryptocurrency made what is called the death cross on September 11th. Now, traders are looking ahead to Wednesday's Fed meeting, expecting the Federal Reserve to keep borrowing costs unchanged. The central bank has raised rates by 525 basis points since March of 2022, all in an effort to control inflation. Now, this move is thought to be partly responsible for this year's crypto crash. Year to date, as we take a look, though, Bitcoin still up over 60%, but crypto experts will tell you not to get too excited. Our very own Jared Blickery has said that the token is not in the clear until it hits 31,000. So still a ways to go, but making some progress this morning. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
All right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
SoftBank is looking to hop on the AI bandwagon. That's according to a report by the Financial Times. According to the report, the company is considering investing in OpenAI and a number of other AI companies. Now, this comes a week after the company successfully listed its ARM unit. For more on this, Yahoo Finance reporter Dan Howley has the latest. Hey, Dan.
That's right, Rochelle. Masayoshi-san is essentially looking for a way to get more AI into SoftBank's portfolio with the IPO of ARM. And so they're obviously looking for different investment opportunities in this space, whether that happens to be a deeper dive into something along the lines of NVIDIA or some other rivals out there. And so this is going to be a kind of big move on the part of SoftBank. Obviously, this is a company that was investing heavily into a lot of startups prior to the pandemic, and obviously their WeWork fiasco that they had to deal with. And now with AI being so important, and Masayoshi-san apparently being in contact with Sam Altman at OpenAI regularly, could be doing some kind of work with that company. So clearly, he is very interested in AI and very heavily wants to know where he can put his money or put SoftBank's money in the space as it continues to grow. And, I know we've spoken a lot about AI this year, obviously, with ChatGPT, OpenAI, Microsoft, and Google, but there still is a long way to go here. This is just the beginning of this kind of revolution in AI, and sure, there likely will be some kind of slowdown or burnout from people talking about it too much, but it certainly isn't going away anytime soon. And we certainly haven't heard all there is to hear about the different applications that you can use AI for. So this is going to be a longer term play for Masayoshi-san and SoftBank.
And Dan, of course, you mentioned Microsoft. So staying in that vein, you're going to the Microsoft event this week. Now, this event comes on the heels of a major shakeup at the company. Panos Panay, Chief Product Officer, stepping down today. So what does this mean when you think about the timing of what's going on with the company and all these big moves in AI?
Yeah, I mean, it really is kind of a surprising announcement just ahead of this September 21st Microsoft event. Rumors are abound that the company is going to announce new hardware from its Surface line, potentially some AI integration with Windows or a greater AI integration with Windows. Panos was heading both of those teams, hardware and Windows. So for him to be stepping down just ahead of this event really is quite shocking. And to be honest, he helped kind of get Microsoft's Surface brand off the ground. And sure, while it doesn't do the kind of numbers that some of the other OEMs might that sell Windows PCs, it really did help provide a blueprint for how those systems can better compete in terms of quality and design with the likes of Apple. If you look back prior to the launch of the Surface line, there were very few manufacturers that were putting out truly good-looking devices. It was basically ASUS and maybe Acer that would have some good-looking products. But with the Surface line coming out, Microsoft essentially using it as a way of saying, this is how you can make PCs that can stand up to Apple and even beat it. They've transformed. And so this is going to be a potentially big loss for Microsoft. They've already announced the successors to Panos. They're breaking things down kind of. Yusuf Mehdi is going to be working on the Surface side of things as well as Windows. So they say that they're still dedicated to Surface, although certainly it doesn't do massive numbers for a company like Microsoft. So we'll have to see what that means. They ended up ending their Microsoft branded accessories line some time ago. Perhaps we'll see some Surface branded accessories. I'm talking about things like mice, headphones, keyboards. They made it a really good keyboard. I'll throw that out there. And so we'll just have to see what happens this Thursday when Microsoft has this announcement and what direction the company is going in these areas now.
We'll certainly have to see a word on the ground there when you go to that Microsoft event later on this week as well. Big thank you there, Yahoo Finance reporter Dan Howley. Thanks so much. All right, well, let's get you a check of the markets, sponsored by Tasty Trade. It's been a volatile session this morning, as we can see here, although all three major indices currently in the green, but just ever so barely as they await the Fed's rate hike decision coming up on Wednesday. The Dow currently up about 14 points. The S&P 500 just barely there, up about 4 points. Similar story for the Nasdaq as well, just barely up there, about 4 or 5 points so far this morning. Well, oil prices are on track to reach $100 a barrel. As crude prices rise, the question remains, can the Fed reach its inflation goal? For more on this, Yahoo Finance reporter Jared Blickery. Jared, I know you're all over this.
Yes, Rochelle. I'm tracking crude oil. WTI is up 1.5% today. And by the way, Brent about half of that. But here we see WTI with a $92 handle. That is the highest price in 10 months. And I'll just show you Brent here because we're talking about $100 per barrel. Oops, that's going to be platinum. Let's see if we can get Brent here. There we go. That is at $94.80, so just short of $95. Already some of the grades coming out of Malaysia and Nigeria, those have hit $100 a barrel. But you only have to go to last week. I've been talking about Jamie Dimon. His prediction for the oil market is we hit $120 per barrel or even $150, and that's over the next 12 months. And what are the catalysts here? Well, everybody needs oil, and we're in a supply deficit right now of about 3 million barrels per day heading into the next quarter. OPEC Plus just threw out that number. Not only that, the SPR in the United States, that is the Strategic Petroleum Reserve, they just started refilling that at higher prices, not the $66 you were seeing a few months ago. So all in all, a very bullish setup going into an election year. So you can imagine the fireworks we're going to see next year. Now, I'd be remiss without talking about the dollar as well. Let's see if we can find the Dixie here. Well, let's try this instead. We got the S&P Goldman Sachs Commodity Index, and here it is over the last 2 years. What I want to show you is that commodities overall are breaking to the upside. You got this little base here, and here we are. We are basically clearing this area in here. Nothing shocking to the upside, but all of this consolidation, this nice, long, extended base, just means that when prices are ready to shoot up, they're going to do that very rapidly, and that is across the entire commodity sphere. Let's see if I can get that dollar chart in here. It's DX, there we go, Y.NYB. This year, we've seen the dollar really pick up since the beginning of July. We cleared this March level. We are right at the highs of the year. Going back over the last 3 years, you can see, well, this latest price action is a little blip on the radar, but small moves in the dollar mean big moves elsewhere, and a higher dollar does tend to weigh on commodities. But what's even more impressive about that crude oil rally that I was looking at, that was done on the back of a rising dollar, Rochelle.
Goodness, well, certainly some signals that I know you'll continue to track for us. Yahoo Finance reporter Jared Blickery, thanks so much. All right, oil markets action ahead. Stay tuned. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going and keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
The United Auto Workers Union is entering day 4 of its strike against the Detroit Big Three automakers. Negotiations between the UAW and General Motors, Ford and Stellantis are ongoing, but have yet to see much progress. Ultimately, a prolonged strike by the UAW won't just leave a lasting impact on automakers. It could have even more broad economic impacts that reach as far as the Federal Reserve's next decision on interest rates. Well, joining us now from Chicago is David Whiston, U.S. Autos equity analyst at Morningstar. Thank you for joining me this morning here. So for people who obviously the main focus is on the big three, but what are some of the economic sort of trickle down effects that we will then sort of see broaden out to the rest of the economy?
Yeah, that's such an important point, because I think some people all over the country or the world, they think this is just a Midwest problem or a Michigan problem or just a factory worker problem. Or it's not. I mean, obviously there's impact everywhere. There's obviously on the auto side and the manufacturing side, you've got supplier plants that are sending parts to these assembly plants, and then the dealers, of course. But if the strike then goes beyond just the Detroit Three in terms of the supplier base, it could start impacting Toyota and other transplants production. That impacts dealers all over the country, not just Detroit Three dealers. Then there's all the other businesses you don't think of that really have nothing to do with the auto industry other than auto plant workers frequent these businesses. That could just be something as simple as the pizza joint or the bar where people get a dinner or a beer after their shift. That business just dries up. Plants are in communities. Obviously, communities have all sorts of merchants, schools, teachers, and whatnot. It's much more interdependent than people think.
And I think that's important context to add there, because as people are looking at this, and as we look at the proposals from Ford and from GM to the UAW here, I mean, the UAW is not going for it. And as you note, neither side has really a good reason to capitulate at this point. So where does it go from here? Who ends up blinking first?
Yeah, that's a question worth many tens of billions of dollars, because honestly, this isn't just about wages. I think it's important people understand that. Normally in a strike, it would just be probably about wages and maybe one or two other key issues. This is about many key issues, some of which I think you've got a graphic here on the screen. But the big ones that are a real problem are things like being paid 40 hours for 32 hours of work every week. That would require a massive headcount increase just to keep output the same, and then reopening the pension plan and reopening retiree health care. That is, per company, that is tens and tens of billions of dollars. And that's why you heard Ford CEO last week, Jim Farley, take the unusual step on live television to say, if we agreed to the 2023 demands 4 years ago, we'd be bankrupt now. I was really surprised he said it, but I think that's the magnitude we're dealing with here.
So then, David, when do we start seeing some of this action here show up in earnings? At what point will we start seeing that, given that it is still only day 4, but they're still very, very part on agreeing on this?
Yeah, and I do think the strike is going to last months. I mean, I very much hope I'm wrong. I hope they get an agreement as soon as this week, but I doubt they will. They're so far apart on so many issues. And then the financial impact here, you know, people always ask me, well, what about the inventory that is already there? You know, how much stock do their dealers have? That's actually totally irrelevant from an accounting perspective for the automakers' earnings, because they wholesale to dealers. So the moment that factory isn't producing vehicles, the moment it's not shipping vehicles, there's no more revenue coming in on the automaker side. The dealers, of course, have some inventory, but the inventory at the dealers is down across the Detroit Three relative to the start of in late August of 19, relative to the 40-day strike GM had then. Inventory is 39% lower. It's about 46% lower at GM alone, but across the Detroit Three, it's about 39% lower. So we're still recovering from the chip shortage. So I've seen a lot of stuff lately about how inventory it's actually good the strike is happening because inventory is getting too bloated. Those people are looking at day supply. They're not focusing on the absolute number. Inventory is still too low.
So then of the big three, in terms of who's perhaps best protected or who can perhaps survive the strike longer than the others, who's best positioned in terms of that, and also the economic impact that it then has?
If you're just asking among the Detroit Three, I mean, the liquidity here is outstanding across all three firms. And I don't cover Stellantis, but they did have over 60 billion euros in liquidity, industrial liquidity at the end of June. I do cover GM and Ford. Both had really high liquidity at June 30. I think it's around 25 billion in automotive cash at GM, 29 billion at Ford, and total liquidity at GM and Ford combined is about 90.1 billion at June 30, with 51 some billion of that at Ford. So you have to do a lot of math here on how long can and you have to make a lot of assumptions about how long, what's the minimum cash to run the automaker's business, how long can they last, and then conversely, what about the UAW strike fund which was roughly $825 million at the start of this. Honestly, given the size of the liquidity here, I think the math is on the automaker's side, but nobody wins financially. This is going to hurt very badly. It's just a matter of how long does it last.
And David, I want to ask you, because we had a guest on the show saying, look, if you're interested in buying a car, now is a good time before the strikes are even more prolonged. But then when you think of where interest rates are and seeing people start to default on their auto loans, and when you meant, of course, talking about inventory as well, is this a good time to buy a car? Should people perhaps hold off until after the strike issues are resolved?
Well, even before the strike, things were very expensive because inventory has been low and is still recovering from the chip shortage. Leasing is still way below where it should be. Before the pandemic went on, you were as high as low 30% in leasing. It's roughly 20% now of new vehicle sales. So there's just not much affordability. And yes, interest rates have skyrocketed very quickly. They're still way below where they were in the early 80s. But it's a very different paradigm, I think, for consumers to get used to, because we've been very spoiled since 2008 with these ultra low interest rates, and those days are over. Is it a great time to buy a car? I mean, I guess a dealer would always say yes to that. I'm not a dealer. Personally, I think you would probably want to wait until something works for your own budget. It just depends on everyone's personal circumstances, what they can afford.
I'm sure people will be tracking the action here and seeing if those strikes end up expanding to more locations. Hopefully they come to a resolution. A big thank you there. David Whiston, Morningstar's U.S. Autos Equity Analyst. Thank you for your time today.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Best piece of career advice that you've ever gotten?
Ask questions and sometimes wait to answer when you're asked questions.
It's that time again. House Republicans have released a bill intended to avoid a government shutdown on October 1st. The deal being tabled is very much viewed as an opening gambit and includes an 8% temporary spending cut for domestic agencies. Now, it isn't likely to be accepted by the Democratic-led Senate, especially as it includes border provisions, which are likely to make the plan dead on arrival. A vote on the bill is planned for this week. Let's get the latest with Yahoo Finance's Rick Newman. Rick, here we are again.
Here we are again, and here we're going to stay, I think, for some period of time. So everything you just described is basically just part of the process. This is no kind of breakthrough. This doesn't mean that there's any kind of deal in sight to keep the government open. It's just one of the hoops that Republicans need to jump through. So what needs to happen is that first we have to see if they can actually pass this in the House, and it's not even clear they can get the Republican votes to pass this thing. And then it's going to go to the Senate. It's going to die because of those couple of reasons you mentioned. The Democrats control the Senate, and they're not going to sign off on 8% cuts and all in spending. So then if it gets that far, then we'll get to the next level and the next level after that. But I have not seen any solid political analysis that says there's an opening for a deal here that keeps the government shut down. It just does seem like we are going to have a government shutdown. And honestly, I don't think ordinary people need to worry about that. We've been through this before. We know the drill. This is not nearly as dire as the problem we had, the man-made problem, I should say, earlier this year when they were talking about defaulting on debt, Treasury debt, because they couldn't raise the borrowing limit. So this is just going to be a tedious and infuriating process that's going to go on for weeks and perhaps a couple of months, I think, before we ever get back to something that looks like normal. So everybody find something else to pay attention to.
I mean, with that in mind, though, obviously we know that the blame game will always be on the table, especially when we look ahead to an election year here. How does this position these candidates if they're not able to sort of find an agreement here and we do have a prolonged, perhaps, shutdown?
I mean, the broader things to keep in mind here are, first of all, Republicans do control the House of Representatives, but only by 4 seats. And they've got this hard right faction. That's the group that's pushing for the fairly severe spending cuts. They want strict new immigration measures, fully knowing that the House may not be able to vote all that stuff in, and that the Senate for sure is going to kill it. So the real question here is how much power this group of hard right Republicans in the House really holds over Speaker Kevin McCarthy. We're back to questions about whether he can keep his job through all this and how far they're willing to go to just obstruct the normal functioning of the country. There are some Republicans who believe, and I think believe correctly, that it's just a losing move to shut down the government. I mean, most Americans don't want this to happen. Even if they agree with some of the Republican causes, they don't think this is the right way to do it. And we know from past shutdowns, I mean, this mainly is a Republican tactic. Democrats don't really shut down the government. They have other tactics. But this has not worked for Republicans. I mean, polls have shown they do. People generally do blame Republicans for shutdowns, and they are the ones essentially causing a shutdown this time. So we are back to this situation we've been at before when it's a relatively small minority of the House that is saying we want to stop the functioning of the government in order to make a point. And Americans in general are kind of like, could you just leave the government functioning and make your point some other way?
Indeed, October 1st will be ticking up quickly, and with not that many days in session left, we'll have to see what happens.
Only 8
Thanks
days,
for getting us
honestly.
up to speed,
8
always.
working days in Congress.
See,
before we
and
get
there you
that
go.
deadline.
To try and cover all those issues. Good grief. Our very own Rick Newman, thank you as always.
See ya.
All right, well, you're welcome. All right, well, let's stay with that conversation around another possible U.S. government shutdown. Let's focus on the potential political and legislative impact for U.S. capital markets. Joining us now is Brian Gardner, Stifel Chief Washington Policy Strategist. Good to have you on the show here. So first off, for investors who are looking at this and wondering, how worried should they be, 8 days away from this October 1st deadline in terms of the number of days that Congress has to pass something? How should they be looking at this?
I think they should and will be looking at it as a market non-event. They're going to look past it. Look back through history. going back 45, 50 years, there have been numerous shutdowns. If you whittle it down to those number of shutdowns that last 5 trading days or more, because a lot of those shutdowns are weekends, so markets don't care, but those extended shutdowns, and I don't think you can find that where a shutdown led to a big market sell-off. Matter of fact, quite the opposite, because I think investors were looking at other factors. But let's just take, for example, the last shutdown, which was one of the lengthier shutdowns we've ever had, 34 days from December 2018 into December 2019. Over those 34 days, the market went up 10%. So, you know, if investors are thinking of freaking out, I would just say, careful, take a deep breath. Markets in the past have not had this big adverse reaction that some may fear to shutdowns. And I think this case is going to be similar to that.
And Brian, I want to bring up something here because obviously, as you've mentioned there, for markets, it's essentially going to be a nothing burger. But IXIC Boltanski from BTIG, he noted some of the concern that might come with delayed government data that the Fed might actually be closely watching, and delayed economic data if we do have a shutdown and we don't have people putting these reports out in as timely of a manner. Is that a concern, you think, for the Fed and some of the decision making that affects markets?
Sure. So for the Fed, I mean, you know, this would come at, you know, we have the meeting, obviously, the FOMC meeting this week that coincides with the UAW strike, which you covered in the last segment, and a potential government shutdown. And with the government shutdown, the potential for a lack of economic data coming out as non-essential services get shelved for temporarily. That could be an excuse for policymakers to pause, right? The uncertainty of the fallout from the strike, the uncertainty of any economic impact, and the lack of data. For a Fed that's data dependent, if they're not getting data, they may just decide to pause a little while. And I think that's kind of what the markets have baked in right now anyway. So yeah, it's an inconvenience for policymakers who are looking for economic data. A prolonged shutdown could leave them blind a little bit for a couple of weeks.
And there are some things that happen sort of on the edges of these shutdowns, things like if you're trying to apply for a small business loan, if you're trying to get your passport processed. But in terms of economic impact versus market impact, we should really be focusing on the economic impact at this stage.
Okay, there are a lot of inconveniences and nuisances that come along with a government shutdown. I don't want to belittle them. You're going to have government employees who are not going to get paid during the shutdown. That's a hardship for them and their families. And so that's a real issue. At the same time, all that back pay and all the inconveniences that go on during the shutdown, they're all made whole once the government reopens. So it's a very temporary economic event and doesn't lead to long-term economic impacts. The government employee, the government worker that doesn't get paid for, let's just say, 3 weeks, that 3 weeks of non-pay will be made up once the government reopens. So the economic impacts really are so small. That's why I think investors look past this as a market event and discount it.
So Brian, as they are sort of looking past it, even, I mean, you have some sectors, some defensive sectors that are more dependent on government contracts than others. What are the markets then focusing on? If they're not right now focusing on this and they don't think it's going to impact them as much, where should markets be focused?
I think it's the Fed. I think it's the UAW strike a little bit, although I think that will take, I think only a prolonged strike there would have a market impact. But definitely the Fed. And Fed and other geopolitical concerns. The China tariff issue has been on the table for quite some time. We may get a resolution from the Biden administration later in the fall on the future of China tariffs, and I expect they are going to be extended, at least most of them. But those are the events. Those are the developments that investors are looking at. And again, the Fed. We'll see what. Not only, the statement this week, but obviously the economic projections that come out and the chairman's press conference afterwards about the path forward, where the Fed is going next.
And Brian, if you were to advise, some of these investors at the moment, or perhaps some people who are looking at this government shutdown, and if it's going to be a nothing burger, are there particular sectors that they should be looking at this time, even if it is perhaps something temporary?
In terms of, I'm sorry, maybe I misunderstood the question, but in terms of looking forward for what sectors outside of government-related entities, government impacted sectors. I think generally a defensive stance right now because of the uncertainty of where the Fed is. I think hold tight, see what the Fed has to say, what the long-term ramifications are for the Fed, what next policy steps are going to be forthcoming over the next couple of months.
All right, certainly in a bit of a wait-and-see period, there's a lot of factors contributing right now. A big thank you there to Brian Gardner, Stifel Chief Washington Policy Strategist. Thanks so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Make sense out of what's happening in China for us, and are we getting any more clarity that we need on the markets front?
So China is stimulating its economy. A lot of people think they're not, but they clearly are doing it. But it takes time, and I think that China is not in a policy that we did, like a big reopening and trying to stimulate it through free checks and say, let's go and spend a lot of money. Chinese consumers are different. They're also very cautious because what happened during extensive lockdowns, they're wary. But there is some change, and I think that this is about China being very gradual in its approach, knowing it can reach its goal for 5.5% growth. It may not happen this year, however, it may be something for next year.
Federal student loan borrowers are bracing for payments to resume at the end of the month, and Yahoo Finance has you covered. In our series, Student Loans, Smarter Strategies, we spoke with experts about preparing for those repayments and a look at how we got here in the first place. Take a listen.
Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it.
The first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment.
President Biden and his administration is committed to taking action in order to relieve student debt. The president has also announced a Plan B under the Higher Education Act and will hopefully be able to provide borrowers even more relief.
Because we've had such a long break, so a lot of people don't even know exactly how much they owe, who their lender is. And so for some people, it starts with answering those basic questions.
The cost of attaining a higher education degree has become unaffordable and unattainable. And so we really do need to look at common sense solutions, ensuring that states are able to adequately fund their higher education.
Women earn degrees at a higher rate. They're enrolled more in college. So they've taken on more degrees. They've taken on more debt. Then they emerge with a degree and they are earning less. And unfortunately, it takes them longer to pay off that debt.
The president is trying to put into place things that will help people who go to college. And we should be really helping people go to college and doing it in an affordable way.
I was a high school math teacher right out of college, and I got my first contract for $29,000 and thought it was like $1 million. For most folks, they know today that not that much, and you can't actually kind of afford to live off that money. Really kind of contributed to feeling a little bamboozled kind of by the system itself.
I think the number one thing is, generally speaking, we tell people not to fall victim to people calling you and asking you for advice. If it sounds too good to be true, it usually is too good to be true.
Everybody thought that student loans of all stripes persist through bankruptcy, but in fact, certain private student loans do not. And we brought a lawsuit to try to stop Navient from collecting on those loans for thousands of people, and we're successful.
What we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt. What's the long-term return on investment? And that's what folks are asking.
So the real question to ask isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself.
We have a survey at Prince Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college.
For loan borrowers, they may not feel that the loan itself is worth it, but the education is.
The education is really important, but people are going to have to start asking, is it even worth taking out these loans because it's just so expensive?
All right, well, that'll do it for now. But before we go, let's get you a final check of the markets. Looking at green across the board now after having a mixed picture this morning. We see all three now touching session highs. The Dow up about 85 points, about 0.25%. The S&P 500 there also up about 1/3%. Tech-heavy Nasdaq there also up about 0.2%. There about 32 points. We're seeing Tesla though under some pressure after Goldman Sachs cut earnings estimates for 2023. So seeing some pressure there. All right, well, that does it for now. I'm Rochelle Akufa. I'm back with you at 11 a.m. Eastern tomorrow. I'll see you then.